markets, headlines, and breaking news 24 hours a day on Bloomberg Radio, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Whole lot of nothing. Major stock indexes, little change ahead of the announcement from the Fed. This announcement for the Fed expected to kick off a series of rate cuts for this year. Now, with very low volumes, only 2 of the 11 major industry groups in the S&P 500 are higher right now. You have energy in the lead. Torsten Slok is the chief economist at Apollo. He says, along with the interest rate decision today, that's 2 p.m. Wall Street time, the Fed's going to be sending an important signal to the markets.
So it does become quite important whether it's 25 or 50 because it signals whether we are in a hurry to do something or whether we still have time to look at the incoming data that still continues to be strong.
Well, the worst performing stock of the S&P 500 right now, that belongs to a company called ResMed. It is down close to 5%. This is a company that makes those sleep apnea machines. Now, analysts say ResMed could be at risk if the GLP-1 drugs now approved for weight loss and diabetes can be prescribed for sleep apnea. I'm not entirely sure what's new about that. Right now, the S&P 500, 7 points lower. That's down a 1/10%, 56.27. Dow Jones Industrial Average is 36 points lower at 41,569. And the NASDAQ 100 right now, 44 points lower. That is down 0.2%. Let's look at oil. Brent crude down $66 cents, 73.06 a barrel. And NYMEX crude, West Texas, that's down 61 cents, $70.58 a barrel right now. As for Treasury yields on this Fed day, 2-year yield, it's actually up 5 basis points right now. That's at 3.65. The 10-year, the benchmark, 4 basis points higher. That is at 3.68. And about 45,000 dock workers along the U.S. East Coast, Gulf Coast, threatening to strike October 1st. This is a move that would shut down ports that handle about half of the nation's cargo from ships. And we check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Alex. I'm not sure how many dock workers they use nowadays, now that so much of it is the intermodal transport.
You gotta
Cranes
get the
picking
stuff
up
off.
No, I think I think it's still a big deal.
Well, it's a big deal, but I'm
Not
just
as big, yeah.
going way back when we had
Stevedores, right?
something
Isn't
like
that the term for those people?
I don't know, but what is this, the olden days? What's happening?
Well,
wasn't
you're
that far.
talking to me. Of course it's the olden
Oh, please.
days.
Is this before the app tracker that Paul sits with on the beach to look at the tankers? Okay. It's Fed Day. In case you haven't heard, you got yields a little bit higher, stocks going a whole lot of nowhere. Joining us now for his take is Jeffrey Cleveland, chief economist over at Payden and Regal. All right, Jeffrey, 25 or 50, place your bets.
25.
Why?
I don't see the urgency to cut by 50. I think, stocks are at all-time highs. Layoffs are quite low. We had a decent retail sales report yesterday. So usually if the Fed goes faster, it's because we're in an obvious financial crisis or we're in a recession. And I don't think you can make either of those cases or of those arguments. So it seems like 25 would be the best path here. But I don't want to protest too much. I mean, I think we're going to go middle of next year. We'll be, 4% on Fed funds. End of next year, end of 25, we'll be at 3.5%. So they want to go faster. I won't protest. It's good for stocks, good for bonds. I like it.
Jeffrey, what do you think, aside from the actual, move on the rates, what are you going to be looking for from the messaging, from the body language and all that kind of parlor game that folks play? What are you going to be looking for in this meeting?
Well, probably first the dots. As of June, we had one cut for this year, and then we had about 4 next year. So look for the change in the median dot where they see the policy rate this year and next year. That's possibly some disappointment for the market because market already expects a lot of cutting out over the next 18 months. I don't know whether that's going to be confirmed by the dots. So
Well, exactly. So are we just looking at like a bond sell-off if they go 25 and don't confirm almost, 5 cuts this year?
Yeah, potentially, because the bond market, it's like at the beginning of the year, Alex, the bond market was expecting 7 rate cuts, I think, at some point in January. So far, we haven't had any rate cuts, so the bond market was wrong about that. So in the short run, yeah, that could cause some volatility. So that's an issue today. I think also the messaging. I think if I was going to build a case to cut more quickly, I would just say, hey, the inflation threat is gone, and the real threat now is, economic downturn or further labor market weakness. And then I would say to everyone, hey, we don't need to be at 530 on the funds rate if inflation is not a risk. We need to get back to neutral, and we want to get there more quickly. That would be the argument, I would say. So how the Fed chair tells the story today in the press conference will also be important to take in.
So, Jeffrey, is it your belief at this point in time that the economy is, in fact, in decent shape? Yes, maybe slowing certain parts, but in decent shape?
Yeah, absolutely. I mean, layoffs are low. I think GDP in the current quarter is tracking 2.5%. We think for the full year we'll be almost 2.5% on GDP, Paul. The unemployment rate's at 4.2%, we think, at year end. So that is still a great environment. Now you got the Fed cutting, so this is very bullish for risk assets, I think, over the medium term. Great for bonds, great for stocks.
Where in stocks, though? I think it was Bank of America, but saying this is a great point for mid-cap stocks because you get the valuation boost from small caps without kind of the risk and the slowing sales growth, but you don't have sort of the top line like you would for large cap.
Yeah, I mean, I think that's a decent argument. I just think that really for me, and if the business cycle has more room to go, then stocks will continue to make new highs, especially if you have now a supportive Fed. So that's the lesson of history in all the different business cycles. When you get to the end of the business cycles, when you really want to get worried about equities and maybe get more defensive, I don't think we're there yet in the next 6 to 12 months. I think the economy will continue to grow. So more like, I guess, a 1990s style soft landing. That would be what I envision for the economy.
Hey, Jeffrey, how about the U.S. labor market? That's obviously something that the Fed looks carefully at here. What's your kind of take on where we are with the labor market?
Well, everyone's been talking about the unemployment rate rising. So in our view, that has happened, but it's due to a, perhaps good reason, expansion in labor supply. That has helped the Fed, actually, because that has eased some of the labor supply demand mismatch. Wages have cooled a little bit. I think from a central bank perspective, they like to see that the labor market is in better balance, but it has pushed up the unemployment rate a little bit. I don't think the labor market it's definitely, job growth has slowed, but we're still seeing a decent enough job growth when you look at the 3-month moving average of non-farm payrolls to keep, I think, downward pressure on the unemployment rate. So when you look at our forecast out into the middle of next year, still have a pretty low unemployment rate, right around 4.1, 4.2%. Okay,
but that's the case, then why do we need like 9 rate cuts?
Yeah, I mean, I don't think you need 9. I think you could build, in our model of it, you can build a case for, let's say, 3 25 basis point cuts this year, Alex, and then 2 in the first half of next year. So more like 5, not 9. Why? Because you don't need to be at 530 on the funds rate if inflation is continuing to moderate. You can take your foot off the brake a little bit, if you will. So, but 9, I can't get on board with 9 rate cuts at this point.
All right,
that's
Jeffrey.
A much more calamitous situation, I think, that some investors have in mind.
Yep, that sounds about right. Jeffrey Cleveland, Chief Economist, Payton & Regal. He's joins us from L.A. via that Zoom thing here. So, again, I guess just kind of review the timing. We've got special edition of Bloomberg Surveillance, Tom Keene, Lisa Bromwich, John Farrell. They'll be simulcasting radio, television, beginning at 1:30 p.m. Wall Street time, taking you up to the statement at 2 p.m., and then the press conference at 2:30 p.m. all Wall Street time. Michael McKee, presumably, I think he saw him leaving yesterday with his bags going down to D.C., so he'll be there, ready to go. We'll have full coverage coming up. And again, 25 or 50, and then kind of the language supporting that decision will be interesting.
I'm kind of 2 minds. Like, one is that we've telegraphed this, and also the Fed so well that nothing's going to actually happen when they cut. And the other mind is that positioning in the bond market is a little funky in that maybe we'll see a big reaction if we don't get 50. Like activity in October Fed funds futures, which investors are using to bet on this week's policy meeting, apparently has jumped to the most extreme level of any contract since the derivatives inception in 1988.
Really?
So like there's just a lot of activity, and I wonder if we're going to see that through. JP Morgan says, look, net positioning is still long, but those positions are quite reduced. So I'm very curious as to how all of that is managed as well. So we talk a lot about how the European Union goes after big tech. Well, big tech had a win. Google's big win in the EU. We'll break that down coming up next. This is Bloomberg.
This is Bloomberg Intelligence with Alex Steele and Paul Sweeney on Bloomberg Radio.
All right, folks, it is Hispanic Heritage Month, and every day at this time, we are celebrating significant moments in Hispanic heritage. Now with your installment for September 18th, here is Bloomberg's Lisa Mateo.
Well, on this day in 1810, Chile began fighting for independence from Spain with the establishment of the first National Congress of the Chilean government. Now, it finally became an independent country 8 years later. Chileans refer to the official holiday as 18, or 18, because the celebration takes place on September 18th each year. Unofficially, the Fiestas Patrias, it can last for about a week, depending on when it falls. Now, the day is celebrated with traditional cueca dancing. So what is cueca music? Take a listen. There you go. Well, the celebration also includes food, games, attending outdoor festivals called fondas. Many Chileans also travel during this time to visit family, friends, and relatives in other parts of the country. That's Today in Hispanic Heritage. I'm Lisa Mateo, Bloomberg Radio.
All right, thanks so much, Lisa Mateo. There's some headlines here out of Boeing, more specifics on their furlough plan. They're going to furlough some workers for 1 week every 4 weeks. They're initiating these temporary furloughs in the coming days. It's going to impact a large number of U.S.-based employees, and it's going to continue for the duration of the strike. Plus, Boeing's CEO and leadership team will be taking a pay cut during the strike, and this comes from Boeing CEO Kelly Ortberg commenting in a memo to employees. So just keeping our eye on those headlines. All right, we talk a lot about how the EU is coming after big tech, and big tech gets a win here. Apparently, the Google actually wins its case against the European Union. We want to get more on this with Tamlin Basin. He is Bloomberg Intelligence Technology Analyst. What was the case again on this? I can't keep track. And how did Google pull off a win?
Yeah, thanks, Alex. It's very hard to keep track because there's so many cases against Google from the EU and against other big tech companies. But this specific case was a 1.5 billion euro fine that was assessed in 2019. And in it, the EU charged Google with abusing its dominant position in search advertising to really strong-arm website publishers into not accepting ad placements from rivals. And these are specifically rival search engines, so Microsoft and Yahoo. Now today, the intermediate court said that when assessing the penalty for that, the EU sort of overstepped its bounds. However, it did sort of largely uphold the finding that Google's practices were abusive in nature. So to some extent, Google may want to hold off on the confetti. But on the other hand, a win is a win, and it certainly hasn't had too many of those recently, especially battling the EU.
So let's take a step back, Tamlin. Give us a sense here. In the States here, as you all know, the regulators over decades have taken a very light touch to regulating technology, and that, one could argue, has been a real enabler of the growth of technology in Silicon Valley. Europe takes a different view, a little bit heavier hand here in terms of that. And this goes all the way back to Microsoft 25 or 30 years ago. Where is the EU these days in looking at big tech?
Yeah, I mean, that's a great question, Paul. And just yesterday, the new list of European commissioners was appointed. So gone are Marguerite Vestager, who really has led in large part the crusade against a lot of these big tech companies over the past 5 to 7 years. However, I don't think we're going to see a significant shift in the way EU looks at what they see as abuses by large tech companies. And of course, most of those large tech companies are American firms. It sees these firms as having abused their dominant positions. Mm-hmm. And coming out of cases like the one that was resolved today, it wrote a new set of rules that are really going to make it easier in the future to bring enforcement actions. And they're going to be much swifter. This case started in 2016. Today was actually just an intermediate court resolution, so that's 8 years. So we could have another few years of this appealed.
Oh my gosh,
in the future, I
8 years.
think there's going to be swifter enforcement. So I don't think we're likely to see a sea change in how the EU addresses big tech.
What big tech is kind of next, and what on the docket? Like what's next on your radar?
Well, so under the Digital Markets Act, the EU has already brought enforcement actions against Apple. This is sort of the same App Store policies that, in some, although Paul's right that there's been a very light touch approach in the U.S., I do think that has changed recently with the DOJ bringing cases against big tech, and the App Store policies are one of those. The EU is also looking at Google's ad tech policies, and it's also looking at Meta in a few areas. So these firms are still definitely in the crosshairs over here.
Is it just a case of just writing checks and going on with business, or is there a fundamental change in how they do business?
Yeah, I mean, there's the potential for some behavioral remedies from these, and the checks could be quite large. I mean, under the DMA, it could be up to 10% of a company's global revenue. So we are looking at pretty sizable penalties. And in some cases, these firms have held off on how they engage in practices over in Europe, especially relating to AI. You've seen sort of Apple not willing to roll out Apple Intelligence to European users as quickly as it will to U.S. iPhone users. And a lot of this is the result of sort of the regulatory uncertainty over in Europe.
All right, we really appreciate it. Thank you so much for all the detail, Tamlin Basin, Bloomberg Intelligence Technology Analyst, joining us on Google. We nailed his last name.
Yeah, you got it.
Yeah, I pretty much been mispronouncing his last name for like the last 4 years. But, you know, maybe I got it right that time, so yay for me. It's Wednesday, it's Fed Day. Taking a look at the markets, equity is rolling over just a touch, and you're looking at the bond market selling off just a touch. 2 p.m. is the announcement, 25 or 50. That remains the question, and then you get that presser. About half an hour after that, we're going to have full coverage for you on Bloomberg Television and Radio, a special edition of The Fed Decides. Tom Keene, Lisa Bromwitz, and John Farrow. Coming up right now, Joe Matthew with Balance of Power. Happy Wednesday, happy Fed Day. This is Bloomberg.
From the world of politics to the world of business, this is Balance of Power. Washington, D.C.
Wall Street waits to hear from Washington. Welcome to the fastest show in politics on this Fed Day. We'll be joined by Stuart Paul at Bloomberg Economics coming up for what to expect 2 hours from now, and by our signature panel with analysis, Rick Davis, Jeannie Shanzano with us on the political implications. We'll have the latest from Capitol Hill today as the House prepares to vote on a stopgap plan to keep us from closing down in just 2 weeks. And new polling out from the campaign trail as Donald Trump makes a beeline for Long Island today with salt and the border on the mind. We start, as always, on Wall Street. Let's set the baseline as we wait for news from the Fed. Charlie Pellet in New York has his eyes on the markets. Charlie, how's it going?
Well, right now we are lower across the board, not just lower. In fact, lows of the session right now. Joe Matthew with the S&P down 12. It is Fed decision day, down 0.2% right now. 56.22 is where we stand on the S&P. Dow Industrials also lower as well right now, tumbling 77. The Dow down by 0.2%, and NASDAQ down 56. A decline there of 0.3%. 10-year yield at 3.68%, with a 2-year 3.65%. Gold higher, a little changed, up just about $1 the ounce to $25.70. West Texas Intermediate crude holding above $70, $70.63, down by about 0.8%. And Bitcoin back below 60,000, 59,450 now on Bitcoin, down by 1.1%. Just under 2 hours to go until we get the answer to the question, will it be 25? Will it be 50? Ron Temple is Chief Market Strategist at Lazard Asset Management.
This is not an economy heading into recession, in my view. We've got a strong economy that's gone from very strong to strong. And the only reason I could see for the Fed to move by 50 is to take out an insurance policy. And I think it is critical, by the way, if the Fed does give us 50 today, that they need to reassure the market that the economy is strong, that the labor market remains strong, but that they've made so much progress on reducing inflation that it's time to rebalance the mandate, much like Jay Powell talked about in Jackson Hole.
And, of course, we'll have a whole lot more on the big market story in just a moment. Lazard's Ron Temple, by the way, interviewed this morning on Bloomberg Television. Contract talks between Boeing and its largest union set to resume today after a first round overseen by a mediator left the labor side, quote, quote, frustrated. Boeing shares are up 0.3%. Recapping stocks lower Fed Wednesday, S&P down by 0.2%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues. Once again, your host, here he is, Joe Matthew.
All right, Charlie Pellet, thank you. Happy Fed Day, Charlie. It's a holiday around here anytime. And yes, the building's going to shake right around 2 o'clock Eastern time when we finally get the answer to this question. I woke up in the middle of the night in a fever dream. My wife told me I was repeating over and over again, 25 or 50, 25 or 50. The fact of the matter is after 2 o'clock, we won't have to ask that anymore. At least we have that. And we're going to talk about not only what the Fed is up to here, what this means for the candidates, but also we're going to talk about the latest on the campaign trail. A little bit later, Josh Green from Bloomberg Business Week is going to be with us. Always look forward to spending time with him. And Rick Davis and Jeannie Shanzano are with us on this Fed Day. But it is with the meeting in Washington that we want to start with here. You can't have a Fed Day without Stuart Paul, Bloomberg Economics, U.S. economist. He's been waking up in fever dreams on the regular waiting for this meeting as well. So how about we just get to the question here, Stuart? The market has priced in certainly 25 basis points, but as we're reporting on the terminal, it's really come down to a coin flip.
It's pretty close to a coin flip. Right now, markets are pricing about 60% odds that we're going to get that 50 basis point cut. That's where we are. We've been there for a while expecting that 50 basis point cut, in large part because of just how quickly the labor market has cooled. We saw that SOM rule triggered in the July jobs report. We've seen the pace of hiring slowing. We saw an exceptionally weak beige book, and some of those more qualitative aspects of economic activity. That's what comes up in discussion at the FOMC. That's what comes up in discussion when all the branch presidents around the country convene on Washington for this two-day FOMC meeting, and we think that Chairman Powell is going to deliver that 50 basis point cut.
I want you to bring us in the room here, because if that is the case, if it's 50, Stuart, how important is it to Jay Powell to have a unanimous decision?
I don't think unanimity is necessary for that 50 basis point cut. I think that everybody's on the same page that the Fed should be cutting at this point, and I don't think that it would be that hard to get 50. I think that what's hard to get a majority of folks saying 50. I think that what is difficult is going to be persuading some of the folks who are more market-oriented in their approach to thinking about how restrictive policy is to co-sign a 50 basis point cut. If you're looking at credit spreads, if you're looking at equity valuations and prices, some folks might just not think that rates are all that restrictive. But what everybody can co-sign is the idea that inflation is sufficiently low and the risks are sufficiently balanced that cutting right now is the right decision. So I think that there could be some horse trading around the table where some of the members agree to say, we'll allow for a 50, we'll get on board with a 50, as long as you don't go overboard in the dovish language used in the FOMC statement. I think that that's what's going to be taking place during the two-day meeting. I think that that's where the Fed members are right now, just in finalizing some of that language before we hear from them at 2 o'clock.
Well, so you brought us right to it. What change in language should we look for, realizing this could come down to some real subtleties here? We've got a dot plot to consider and a news conference. Stuart, tell our viewers and listeners what they should be watching for.
The first thing to watch for is the dot plot. What we have so far, what we have in hand right now is from June, which is exceptionally stale. So expect the median target for the Fed funds rate to show about 100 basis points of cuts this year, probably another 100 basis points of cuts next year. Markets are pricing about 115 basis points of cuts this year and 130 next year. That's probably too aggressive. We still will see some revisions to the forecast for GDP growth and to the unemployment rate. We're expecting the forecast for the unemployment rate to rise from about 4.1% to about 4.4% for the rest of this year, which is a pretty notable development. It doesn't sound like a lot, but it is a lot for monetary policymakers who had been just focusing on inflation for the longest time.
Well, then Jay Powell gets to walk into the briefing room and dance with the likes of Michael McKee and his colleagues. He's going to have some interesting questions to answer today. How much will we get into what's going to happen the rest of the year? Of course, he's got a dot plot to explain, so I suspect we'll have some additional visibility once he speaks with the media.
That's right. So I think that Chairman Powell is going to come out and try to thread the needle pretty delicately. The thing that's difficult is that market pricing right now is just so aggressive. Even if he does deliver a 50 basis point cut, a pretty dovish move, he's going to need to try to signal to the market that things are not deteriorating. Things are, it's still a steady ship, and he can deliver that soft landing. I think that some of the questions that he'll be fielding will probably be backward looking, asking if he has regrets about not cutting in July. I think that he'll also probably field some questions about cutting so soon ahead of a presidential election. Right. And then I think beyond that, folks are going to be focusing on what some of the drivers were for changes in the dot plot.
Then we'll, of course, get a flood of statements from lawmakers, including the likes of Elizabeth Warren, who say they didn't go far enough. Stuart, it's great to see you. Stuart Paul, Bloomberg Economics, setting the table for us here. Of course, special coverage on Bloomberg TV and radio begins at 1:30 p.m. Eastern Time. We've got a little more than an hour left together as we set the table for a Federal Reserve meeting and, of course, the aftershocks that will land on the campaign trail. It's always a good day when I hear Josh Green is coming on the show. Of course, reporting and columnizing for Bloomberg Business Week on this day that we find Donald Trump on Long Island. James Mahoney, our producer, is still with us today, despite the fact that Donald Trump is going into the Coliseum. He's going to be talking about salt. He's going to be talking about the border. That is the big event here today, promoting his promise to get salt back. Remembering that he's the reason why this was an issue to begin with. J.D. Vance in Raleigh, North Carolina, and we're coming off Kamala Harris's big day at the NABJ. But with the Fed meeting in mind, the economy is something that kind of directs our focus today, and that's where we start our conversation with Josh. It's great to see you. Welcome back.
Great to be back.
Balance of Power. You've got a couple of columns I want to ask you about. One of them is awfully important as we consider this economic conversation. Mm-hmm. Democrats aren't sure which Kamala Harris they're going to get. Yeah. And you bring us to the sidelines of the convention where we, of course, brought our audience here, and the debate around, specifically when it comes to the economy, what version of Kamala Harris we're going to see. She had an opportunity to speak to the Business Roundtable this week. Tim Walz is apparently going instead. When do we find out?
Well, we'll find out the day after Election Day. Okay. And so you know, one of the stories that I wrote for Business Week was about a conversation that was happening on the sidelines of the Democratic Convention among Democrats that really has not gotten any airtime at all because it's one Democrats don't want to have publicly. Mm-hmm. And it's the anxiety, especially among progressive Democrats, people like Bernie Sanders, Elizabeth Warren, and AOC, about what Kamala Harris really stands for. She doesn't have a kind of clear set of policy priorities. She's made very friendly noises toward the business community, whether it's Business Roundtable or the people she surrounded herself with, and yet these progressives don't want to come out and publicly challenge her the way you would in a normal presidential election cycle because it's so late in the game, and they don't want to give Donald Trump anything to attack her with.
Which kind of leaves her to her own devices here. But what does Wall Street think? Because this conventional wisdom that Donald Trump is friendlier inherently to the markets brings us to an interesting standoff here because Kamala Harris hasn't, for instance, said that she wants to tax unrealized gains or some of the other things associated with Joe Biden. So does Wall Street know what it's getting?
I don't think it does, but the sense I've had in talking to people and talking to Wall Street lobbyists and in talking to kind of pro-business Democrats is that they're really feeling good about Harris. And I think the reason for that is because she hasn't had her feet held to the flames by progressives like Elizabeth Warren. And so she's, in a sense, been able to present herself as being all things to all people. And that's a wonderful superpower if you're a politician.
Well,
I think that's one of the reasons why she's been able to unify the Democratic Party. But on the other hand, if you look at some of the things she's talked about in her economic speeches, attacking price gouging, that sort of things, these are noises that you would hear from a Sanders or a Warren and not something I think Wall Street would be super excited about. So I think she's really a big question mark for all Democrats.
That's a great point. She did a pretty long interview yesterday. I know she's getting knocked for not doing many of them at the NABJ, as I mentioned, as she really leaned on housing as the issue to appeal to not only the people in the room, but the crowd she's trying to reach on the campaign trail. That's not Wall Street, right? She's talking to consumers, people who don't feel like they have a foot in the door, literally.
Yeah, I mean, the way I think about it is that what Harris has done is present herself as a kind of middle-of-the-road populist. And what I mean by that is she's sought to address the economic concerns that a lot of people have. In light of all the inflation we've seen under the Harris-Biden administration, housing prices have skyrocketed. It's hard to buy a house. We know from polls, I know from talking to voters, people are angry about that. They're concerned. So what she's doing is trying to allay their fears. So I don't think that was a message necessarily about Wall Street. I think it was her trying to convey that I am a different politician. I'll be a different kind of president than Joe Biden. I'm going to help bring down house prices. I'm going to help you buy a house.
Well, whatever economic message Donald Trump is trying to get forth, and you can tweet me, start sending them now. It's being clouded by what in the world is going on in Springfield, Ohio, which is something else that you're writing about as well. There's been some really great journalism the last 24 to 48 hours, getting to the bottom of where these rumors came from of Haitian immigrants eating pets and, as Donald Trump suggests, geese. Apparently, at one point, this is a woman who had lost her cat and thought she found the cat later in the basement and apologized to the Haitian immigrants in her community. The campaign, according to the Wall Street Journal, reached out to the city manager in Springfield on September 9th to find out if there's any truth to these rumors. The answer was no. It was the next day Donald Trump put them on television. And the way you're getting to this is, it's kind of scary. A rational-minded debate viewer might have assumed Trump's charge would hurt him. As you say, experts on misinformation say that's not generally how it works. Tell us why and how scary that
I've done a lot of reporting on misinformation over the years, and this was just a wonderful distillation of how it works and how it doesn't necessarily work like people would think it would. Most rational-minded people, as I wrote, would think that sounds absolutely crazy. This is going to have to boomerang and hurt Donald Trump. Sure. Why would he say something like that? But in speaking to disinformation experts, I said, that's not really how it works. What Trump is doing there is trying to reprogram the news conversation, what people are talking about. And I'll admit, as somebody who's watching the debate in real time and writing my instant analysis on Bloomberg, I thought the big takeaway was the weakness of Trump's answer on abortion. His kind of meandering inability to say whether or not he would support a federal abortion ban. I thought Harris was the big winner on that issue, and that was going to dominate the conversation. Yet here we are, more than a week later. What are we talking about? Abortion? No, we're talking about misinformation about pet eating, and what that's done, according to these disinformation experts, is it's really shifted the topic of political debate onto a subject, immigration, that Trump and Republicans are much more comfortable talking about. And it's denied a kind of media oxygen to talk about things that might have been more advantageous to Kamala Harris, whether it was Trump's inability to sort of explain how he'd replace Obamacare, or whether it was his various attacks on her race and her qualifications. Nope, here we are talking about what Trump wants to talk about, which is kind of where we've been in the news for the last 8 to 10 years.
Well, I guess that's also true. It was trending on Twitter before we went home that night of the debate, and it was everywhere, of course, that next morning. You did reach out to the campaign, which has essentially been blaming the media on this. But of course, to your point, on Sunday morning, this was the topic. J.D. Vance said, I created stories like these to made a lot of us wonder what his motivations were.
Yeah, and Trump has subsequently praised Vance, his vice presidential nominee, for creating stories about this. And
did he mean that literally?
With Trump, you can never quite be sure, but he usually says what's on his mind. Yeah. So I think you probably can. Yeah, but what Vance explained and what the Trump campaign said to me was, look, what we were trying to do was shed a light on the problems that the influx of Haitian immigrants have had on Springfield, Ohio. The campaign spokesman did not mention pet eating, but said, public safety problems, stresses on public services, that sort of thing. Again, trying to redirect the news conversation to a subject that they feel is stronger for them than the various other things that Trump said in the campaign. As wild as that sounds to somebody who saw the debate in real time and asked themselves, what on earth is Trump talking about?
We're out of time, but do you think he actually goes there? Donald Trump says he would visit Springfield.
It's hard for me to imagine how he could resist. It would be a scene, and Donald Trump would be right in the middle of it, and that's where he always wants to be.
Imagine the logistics behind a visit like that with state police already trying to keep people safe in Springfield. I'm really glad you could to come see us. Let's do more of this between now and November.
Sounds great.
If you'd indulge me. Bloomberg Business Week, of course. A couple of great columns for you to look out for from Josh Green. I'm Joe Matthew in Washington. We've got a lot more ahead on the fastest show in politics. Thanks for being with us on Bloomberg.
It's 12:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ all remain lower. 1 hour, 39 minutes to go until the FOMC decision. And right now we have got the S&P little change, down 3 points, 56.31, where the S&P stands, down just under 0.1%. We've got the Dow now down 38, down 0.1%. NASDAQ also lower by 0.1%. Stocks right now trading water ahead of the 2 o'clock FOMC decision. 10-year 3.63%, 68%. 3.68 on the 10-year. The 2-year right now, 3.64. Spot gold, little changed, up less than 0.1%, 25.70 the ounce. West Texas Intermediate crude oil down 0.6%, 70.77 for a barrel of WTI. Housing starts in the U.S. bounced back in August after tumbling a month earlier, illustrating uneven residential construction as builders weigh inventory levels against brighter demand prospects tied to falling borrowing costs. As a group, though, we've got home builders lower, Toll Brothers, case in point, down 1.4%, Lennar down 1.2%, KB Home lower now by just about 0.2%. And an update on the Boeing strike, getting word that Boeing CEO and the entire leadership team say they will be taking a pay cut during the strike. Boeing shares up 0.4%. Again, recapping, a little change on the S&P right now, down just under 0.1%. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Balance of Power continues. Back we go to Washington. Once again, your host. Here he is, Joe Matthew.
All right, Charlie, thank you so much. Watching Wall Street on this Fed day as we get ever closer. We're just about an hour away from our special coverage, so do stay with us here on Bloomberg as we bring you, of course, the Fed decision at 2 o'clock. Some smart talk in advance. We'll have the news conference for you and a lot of analysis on the other side, as you would expect here on Bloomberg. Meantime, in Washington, we've got an eye on Long Island. This is going to be the scene tonight. Uniondale. Producer James' ears are ringing. As we head to the Nassau Veterans Memorial Coliseum. There was a chopper shot over the Coliseum. What happened to it? I guess we'll get you a bird's eye view at some point here, because Donald Trump is, yes, going to the swing state of New York today. And by that I mean the very blue state of New York today. Long Island's got its own contours. But we're talking salt, so suddenly it makes sense. I was talking with Wendy Benjaminson about this a couple of days ago. Why New York, people ask. So I wonder which one came first. Did he figure something that would be good for this crowd, or did he want to go to New York to potentially put this in play with the idea of salt? Wendy, of course, Bloomberg Washington senior editor, back with us at the table here. We have to remind everybody the reason why this was an issue is because of Donald Trump's own tax policy in 2017.
Yes, exactly.
So is he arguing with himself here?
He is arguing with himself. Well, he's arguing with 2016 Donald Trump.
Well,
so 2024 Donald Trump has a different idea. 2024 Donald Trump also is going to, as you said, Uniondale, Long Island, Nassau County, in this fever dream he has that somehow New York will become a competitive state. New York will not be a blue state. It is true, Staten Island, parts of Long Island, upstate New York are all some could have conservative voters and can be considered Trump country in some places, but New York City tends to suck up all the oxygen of the electorate there. So it's highly unlikely he will carry New York, but he is making a play for it. When he saw that some of the House Republican candidates there, the incumbents, and some challengers are doing pretty well. So off he goes to Uniondale, and yesterday he decides he no longer likes his cap on state and local taxes at $10,000, which hit New Yorkers very hard because of the cost of housing there. And now he's ready to take it back.
All right. Well, I mean, it's going to play well in the room.
Yeah.
It won't mean anything to people who don't live in a couple of states that are really impacted by this, however.
Right.
And aren't those places where the undecided swing state voters live?
Yes, largely they are. So I think this is just one of his tailor-made, coupon for Nassau County today.
Well, they got Bloomberg talking. I mean, I guess that's something.
Exactly.
You just wonder, though, and I don't know that there's a real answer for this, whether geography matters in the way that it used to, or at least for Donald Trump. A Trump rally is like a concert, right? Some people watch it on YouTube. They cut it up. It's all over Twitter the next morning. Does it matter where it takes place?
No, probably not. I mean, the voters there will hear it. They will like it. But then they also have to know that there will be the sum total of the rest of what he says. And if his appearance in Michigan yesterday was any example, he will be all over the map. He will talk about the guy hiding in the bushes at his golf course on Sunday. He will talk about, how awful he thinks Kamala Harris is. He will talk about how he won the 2020 election. He'll throw in a tax break. He'll talk about tariffs. He just sort of goes all over the map.
Right. Well, we went to a whole new place on the map last night, although maybe it brought us back to the whole childless cat lady thing. The rhetoric has been very distracting from the policy because that's typically what we like to focus on. But Donald Trump did a town hall last night that was run by Sarah Huckabee Sanders, his former press secretary, governor of Arkansas, who took a new shot at Kamala Harris. Let's listen. We'll have you respond.
So my kids keep me humble. Unfortunately, Kamala Harris doesn't have anything keeping her humble. You You would think after 4 years of straight failure, she would know a little humility. Unfortunately, she doesn't.
It's pretty tough, personal stuff referring to, I'm assuming, the fact she doesn't have biological children.
Like it,
you
yeah.
got the mispronunciation, the Kamala and the whole thing. Who's the audience for that? We remind everyone every day, this is coming down to this tiny slice of easily offended, I presume, undecided voters who maybe at one time were double haters.
Right.
That's an opportunity.
It is an opportunity, and it's very unfortunate, I think, that the Republicans are dividing women like this. They're dividing women, as we did 40 years ago, into women who decide to focus on work and women who decide to have children. Many, many, many of us have done both, and they're just like men do. And this idea that women are, this anachronistic idea that somehow women are less if they don't produce biological children is not a way to win over independent voters, not a way to win over the undecideds. Certainly not a way to win over people in Nassau County.
Well, there you go again. If suburban women are going to decide this election, these are the things that make you wonder.
Right.
Kamala Harris was before the NABJ yesterday. We talked when Donald Trump made a lot of news before that same organization. And she was asked about, I think she found in some way a presumptuous question about her appeal to black voters. And her response was interesting. Let's listen to how she answered this.
I think it's very important to not operate from the assumption that black men are in anybody's pocket. Black men are like any other voting group. You got to earn their vote. So I'm working to earn the vote, not assuming I'm going to have it because I am black.
So, Wendy, let's take that thought and run with it for a moment, reminding everybody that you're the force behind our Bloomberg News swing state poll, and you have a sense of the changes that we've seen since Kamala Harris went to the top of the ticket. We went from a conversation about young black men breaking for Trump, which was a big theme this summer, to something that might be unquantifiable now, although she clearly has a lead among young black voters. But it's not a monolith, and I wonder if you can describe where that contest is between Harris and Trump now.
Well, I think, for one thing, it's very typical for politicians to say, I'm going to earn your vote. I'm not just going to assume you're going to vote for me. That's sort of standard fare. What's really interesting to me about Harris's approach is that she is sort of taking this almost post-racial approach to her race. She will not discuss Donald Trump's insults about her race. She is talking about the need to earn the black vote, and she makes her race incidental to her campaign, which I think is a good tactic against Trump, who talks about black jobs and how she just turned black and
the identifier.
As the identifier, I think it will serve to create a difference between her and Trump, where he considers black voters to be a monolith. He did successfully peel away some support from Joe Biden. Right. And I do think Kamala Harris has to work on the black vote. I think she's working on it. You know, when she first got in the race, she had that Black Men for Harris big Zoom call. There's been a lot of talk about it. But on that call back in July, there were a lot of black office holders, men, who were talking to the men on the call about how it's okay to vote for her. It's okay to vote for a woman. And I think that might be a hurdle she has to cross, but she seems to be willing to work on it.
The way you describe her approach to this issue as incidental is very much a page out of the Obama book, is it not?
Yes, it is, although he didn't need to, because the weight of the possibility of him being the first black president, I think, was so present that he almost didn't have to do it. Now she can benefit from his work becoming the first black president, and she's going to be another black president. She'll be the first Asian American, she'll be the first woman, she'll only be the second black president, and it's still a huge deal. And if she cracks that ceiling, it will be a historic moment. But she's able to relax a bit into it and focus on other things.
Well, it's a fascinating moment when it comes to messaging from both campaigns here. This is a vice presidential debate coming up, Wendy. 67 million people watched that last one.
Yeah.
We're all heading back up the Amtrak corridor for something on October 1st. Is it going to matter?
Probably not, but it'll be fun to watch.
Do people care? They want to see J.D. Vance dance with Tim Walz, or is that just us?
Well, it's definitely us.
Sure.
I mean, I'm going to have the corn popped here in the newsroom, but I think this one will be sort of interesting because they are such different people. They have by separately sort of argued at each other, you know, about families and about what makes a family and things like that. And J.D. Vance, I think people want to see his demeanor. I think they want to see if Tim Walz can really handle himself in a debate like this on the national stage. J.D. Vance is already a senator. So, you know, I think it's going to be a really interesting debate. I don't think people vote based on the vice president.
Yeah, well, even Donald Trump will tell you that.
Yes.
You saw we have new numbers out of Georgia's School of Public and International Affairs within the margin here. This is in affiliation with the Atlanta Journal-Constitution. Likely Georgia voters, Trump beats Harris 47-44. Roughly 7% of voters say they are undecided. This narrow slice is who they're going to be talking to that night.
Exactly right. And Georgia's really would be a huge prize for Harris to win. It was sort of a fluke that Biden won it in 2020, and by, as Trump says, 11,700 votes in his famous call to the Secretary of State to overturn that. But so that's tiny for a state like Georgia. And so I think we're going to see them spend a lot of time in Georgia fighting for that.
Adding this to our swing state lineup.
Absolutely,
here.
It's in our swing state lineup, you know, and we'll see.
For good reason.
Yeah.
Wendy, thanks as ever. Wendy Benjaminson, Bloomberg Washington senior editor. I will compare notes on the SALT speech tonight. I'm deeply curious to hear how he gets to this. I'm Joe Matthew in Washington. Glad you're with us here on Balance of Power. We'll assemble our panel next. On this Fed Day, we have Rick Davis and Jeannie Shanzano. Kaylee Lyons will be here in about a half an hour as we make our way ever closer to special coverage here on this Fed Day on Bloomberg. That's just about an hour from right now, so stay with us here. I'm Joe Matthew. This is Bloomberg.
Street. We do check markets all day long here at Bloomberg. A little change on the S&P. 1 hour, 20 minutes to go until the Fed decision. Our coverage kicking off just about 40 minutes from now. We've got the S&P in the green. Right now, the Dow trading lower, down 17. Little change there. NASDAQ also little change, down by 6 points with a 10-year that's yielding 3.68%. The 2-year, 3.64%. And right now, West Texas Intermediate crude oil is down 1%, 70.44 a barrel. Gold also little changed, up 0.1%, 25.72 the ounce. Stocks are wavering amid uncertainties on how aggressive the Fed will be with rate cuts after holding them at a 2-decade high for more than a year. Economic news today. Housing starts bounced back in August after tumbling a month earlier. And with that story, here's Bloomberg's Vinny Del Giudice.
Starts rose at the fastest pace since April. Building permits, a gauge of future housing activity, also increased. Construction of single-family homes alone posted the first gain since February. Multifamily projects declined, though. Builders are awaiting sustained demand to help work down the inventory of unsold homes, one of the largest since the 2008 financial crisis. Vinny Del Giudice, Bloomberg Radio.
Amazon.com is raising the pay of its hourly warehouse workers by at least $1.50 an hour and tacking on Prime memberships to their benefit package. Amazon shares, they're lower right now. Little changed. Amazon down by about 0.3%. Again, recapping, S&P unchanged on the day now. Both the Dow and NASDAQ are trading lower. For on-demand news, 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. Balance of Power continues. Back we go to Washington. Once again, your host, here he is, Joe Matthew.
Charlie, thank you so much for being with us. As always, eyes on the markets here on Balance of Power as we talk politics. We are keyed in on Wall Street and the economy today. Of course, we'll be knee-deep in special coverage of the Federal Reserve 1 hour from right now, so do stay with us here on Bloomberg as we will finally answer the question, 25 or 50. New polling out as we prepare to bring in our panel from the swing states, and this is a pretty big deal. With, again, the economy in mind. We've been asking, of course, voters in our own swing state poll, who do you trust? Who do you trust more to handle the economy? Interest rates, the price of goods. And nowhere more does that matter in the 7 swing states that are going to decide this election. And we can drill down even more with the help of Quinnipiac University, out with new polling today from 3 key swing states: Pennsylvania, Michigan, Wisconsin. You know why we're talking about them if you're familiar with this program. Before I even read you the numbers here, because this does bring good news to Kamala Harris, Quinnipiac pollster Tim Malloy writes, the GOP's most go-to attack strategies against Democrats on immigration and the economy may be losing momentum. Likely, voters now see little daylight, he writes, in most cases between Harris and Trump on who can best handle those key issues. So here we go. Headline numbers: Pennsylvania, Harris 51, Trump 45. Michigan, Harris 50, Trump 45. Wisconsin, Harris 48, Trump 47. She's leading, if not within the margin, in all 3. But how about the economy? This is important. Likely voters were asked who they think would do a better job handling 5 issues, including this one, the economy. Pennsylvania, they're basically tied now. 50% go Trump, 48 Harris. Michigan, 50% Trump, 48 Harris. Wisconsin, a little bit more of a gap. 51% Trump, 47 Harris. She was underwater on these numbers, of course, until now. And that's where we start with our signature panel. Rick Davis and Jeannie Shanzano are back with us today. Jeannie, of course, political science professor at Iona University and senior democracy fellow with the Center for the Study of the Presidency and Congress. Rick Davis, partner, Stone Court Capital. They are both Bloomberg Politics contributors. It's great to have you here as these polling numbers hit the tape. We've got a couple others today worth looking at. But, Jeannie, when you drill down on the economy specifically in these swing states, this looks like real progress for Kamala Harris. How do you read it?
It does. And, you know, I think I read it in 2 ways. Number one is it's a reflection of the fact that many voters were frustrated. They didn't feel like Joe Biden, given his age and several other factors, could fight for them. So he was having a difficult time on those issues. So we've got a new candidate. And the other factor is the numbers have improved in both of these areas. You look at immigration, the number of people coming across the border is way down. We're not hearing as much bad news from the border at this point. That's why Donald Trump has decided to go up to Springfield, Ohio. You look at the economic numbers, reports that for the first time since the pandemic, people are seeing an increase of about 4% in an increase in their income. And so these things are reflecting today. We're looking at maybe the first interest rate cut in a long time. So the real numbers are helping out with a new candidate, and we're seeing them close the gap. Donald Trump still owns these issues, but now it's almost in all cases within the margin of error.
Rick, I'd love your take on this. We should mention the methodology here for a moment. 1,300 likely voters in Pennsylvania with a margin of error 2.7%, slightly smaller samples in Michigan and Wisconsin with slightly larger 3 percentage point plus margins of error, again, for Michigan and Wisconsin. What is Kamala Harris doing right here, or is it Donald Trump not talking enough about the economy?
And before I get to that, Joe, I do want to add to your sort of description of the polls, and it is multi-candidate field, so it isn't head-to-head. It includes Jill Stein in Michigan, that a lot of people worried about. And so I think these are probably the best pictures we've seen in a long time after the debates, after all the things that have been going on to properly reflect the state of the race in the blue wall states. Again, was, like Jeannie said, the base of the Biden campaign was the blue wall, and it appears it may be the same for Kamala Harris. The reality is, when you're running campaigns, you don't want to see your opponent at that 50. That's a bad number. 48, 49, 47, you still got like, okay, there's a window I can get there. But the reality is, you don't see Trump busting that 46% number very often. And the fact that the Harris campaign has gotten up over 50% in two of the key battleground states in the blue wall has got to be a very big concern for the Trump campaign. The fact that she's riding that popularity on improvements with the economy and immigration is equally disturbing. They have to have those issues on their side. It has to be a wedge in order to motivate their own candidate, their own voters. And so, I think it's a perilous place to be. We've seen other polls in other, Sunbelt states that reflect a little bit better activity by Trump. But the reality is there's not much you need. If you win the blue wall and one electoral vote in Nebraska, you're president of the United States. That's 270. And so this has got to shake up the tribe down in Mar-a-Lago. They got to be looking at this hard. And then today, you see Donald Trump futzing around in New York when he ought to be in Pennsylvania, Wisconsin, or Michigan.
Well, and these are the three states, again, that we're talking about here, the actual swing states. And, Jeannie, it's not just the economy that we're looking at here. Donald Trump does lead Kamala Harris, but it's, in fact, within the margin in Michigan, for instance, when it comes to immigration. That one really jumped off the page to me here. It's much more pronounced in Wisconsin, 52% go Trump, 45% Harris. Michigan, though, is 49 to 48. Pennsylvania, 50 to 46 for what is one of the most powerful issues that Donald Trump has. And I'm going to point you to another one, an Ipsos Scripps poll today, finding broad support for this idea of a mass deportation. A majority of Republicans, maybe not a surprise, 86% support the idea, but guess what? So do a quarter of Democrats, 25%. To Rick's point, Jeannie, if Donald Trump just talked about these two things, the economy and the border, in the three swing states for the rest of this campaign, would that not be a strategy?
It's a strategy. It's a better strategy than we've seen. I think when we talked to Republicans after the debate, many scratched their head as to why Donald Trump it makes sense to keep pivoting to immigration, which he did consistently. He did not do the same when it came to the economy. And many Republicans wanted him to do that because that has been a weak point for Democrats. And now these polls, we see her closing this gap. So that would be a strategy to talk about these two issues consistently in the blue wall states. I understand why Donald Trump is in New York. I'm in New York, love New York, but to Rick's point, probably not the best use of your time when you're about 50 days. But I would say this Ipsos poll is utterly fascinating. One thing I would caution against these kind of polls is sometimes they are a reflection of people's real frustration with government's lack of addressing an issue. And in this case, it's immigration. It's been a crisis for decades. It has not been addressed in the way it should. We know that. But I am not sure that people would hold this opinion if they saw in real time what a mass deportation looks like. So I have some concerns about this poll. You can look at the mass deportation if it happened from a lot of perspectives, including the cost, but just from the humanitarian perspective alone, I think you'd see a decrease in that number if it came to fruition. So I think this is more a reflection of people's concerns, which to your point means Donald Trump should be talking about this issue, but he's also got to hit on the economy in these swing states, because when she closes this gap this way, that is a problem for him, because how does he surmount that?
I don't know what your thought is on this this mass deportation poll, Rick. Jeannie, you might have a point. When people start seeing the police knocking on doors at their neighbor's house, 25%, though, a quarter of Democrats think this is a good idea, at least on paper. Rick, how would you exploit that as a campaign operative?
Look, I mean, I think that the president has not, President Trump has not done enough to articulate plans on how to mitigate immigration. It's almost been, sort of his go-to place. He likes to talk about Springfield, Ohio these days, which actually isn't a policy. And the reality is, if he did talk more about articulating his plans for things like a deportation or strengthening the border, or what's he going to do with Mexico? I mean, the reality is he did more of that in 2016 than he's doing today. And he's not doing himself any favors, because as you see from these polls, and as Jeannie articulated, people universally are frustrated with the southern border, and they want to have it fixed. And the fact that Donald Trump actually can point to, numbers on the southern border that are better than the Biden-Harris administration, it's stunning to me that he doesn't talk about it more. The reality is he's so into sensationalizing these issues, talking about Haitian immigrants eating dogs and cats, which he has to make up in order to do it. He would be much better off talking about the facts on the ground and real solutions. And I think he would really cut into Democratic margins on this. As you see in this current blue wall state poll, I mean, Harris is now caught up to him on immigration in those places.
That is remarkable, and I know that he's going to talk about it a lot tonight. Jeannie, at the Coliseum, Donald Trump on Long Island, he's going to be in Representative D'Esposito's district talking about this, and you know how that plays in that district. Can Donald Trump do himself a favor, even though he's in New York, with considering the audience, the reception he's going to get tonight, and the social media coverage that will follow?
He absolutely could. The reality is that Long Island is a conservative place. People are very frustrated all across the country, but in New York in particular, about the issue of the economy and about immigration. But he has to Rick's point, lay out a plan. And the problem with what he's been doing with this issue in Springfield, Ohio, is that he is talking about something that if you just take a glance at social media, people are laughing at. They have dogs and cats running away from Springfield, Ohio, memes all over the place that Democrats could never buy. But the reality is this is a serious issue for people. In New York, just as an example, the immigrants that have come up here, that have been sent up here in many cases by Southern governors, have flooded the school districts. This is a problem for people in New York. So talk about the pain they are feeling and how you're going to address that, rather than talking about unsubstantiated rumors, which have now been totally debunked, about people eating cats and dogs, and that would do him a favor. But I would also caution, it wasn't long ago on Long Island, as you know, Joe, we saw a Democrat take on the issue of immigration very successfully and win. So Donald Trump has his work cut out for him. He's got to be disciplined, and that's not his strong suit in these rallies.
Well, we'll be listening closely to the message tonight inside the Coliseum with Rick Davis and Jeannie Shanzano. Our panel will be back in our second hour as we walk up to our Federal Reserve coverage. I'm Joe Matthew in Washington. Stay with us right here on Bloomberg.
politics to the world of business. This is Balance of Power. Live from Washington, D.C.
Counting down to the Fed, with new polling showing Donald Trump and Kamala Harris essentially tied on the issue of the economy in two key swing states. I'm Joe Matthew alongside Kaylee Lyons in Washington. Welcome to Balance of Power. Kaylee, it helps us frame this Fed decision from the perspective of the campaigns, what we're going to hear a couple of hours from now.
Yeah, of course, we're referring to the new polling that just dropped from Quinnipiac, looking at the blue wall states, Michigan, Wisconsin, and Pennsylvania. In Michigan and Pennsylvania, Harris now leading Trump. They're tied in Wisconsin. But when we consider the way in which Harris has moved up in the polls compared to where Joe Biden was, it does seem like one of the factors is the economy. To your point, she's only 2 points down against Trump on that issue in both Michigan and Pennsylvania. And if already she's getting more credit on the economy with battleground voters, what happens when interest rates actually go lower?
Especially if it's 50 basis points. And we at last today will be able to answer the question, 25 or 50. Our special coverage begins a half hour from now, the decision an hour away. Kaylee at 2 p.m.
Yep, and of course we'll hear from Chairman Powell half an hour after that. He's probably going to have some questions to answer, probably is going to have to make the point that the Fed is not thinking about politics and it's thinking. I do wonder how quickly we may get reactive statements out, frankly, from both parties. Thinking Senator Elizabeth Warren or even the Republican nominee Donald Trump. Watch Truth Social.
You don't think those timed emails have been sent already?
Well,
we'll find out
there's
together.
also that possibility. So let's take a check on where markets are ahead of this crucial decision. Charlie Pellet has a look from New York. Hey, Charlie.
Thank you very much. Indeed, we are higher across the board right now, 25 or 50. That is the question. 1 hour to go until we find out for sure from the FOMC. Our coverage on Bloomberg Radio and Television coming up 29 minutes from now. Right now, right to the numbers, we got the S&P higher by 6 at 56.40, up by about 1/10%. The Dow also meandering higher, up by about 1/10% higher by 23 right now. NASDAQ also up by 1/10%. 10-year at 3.67% with the 2-year checking in at 3.64%. Gold little changed, up $4 the ounce to $25.74. A retreat for West Texas. Intermediate crude down 0.8%, 70.62 right now for a barrel of WTI. Bottom line here, stocks have been wavering higher now amid uncertainties over just how aggressive the Fed will be. Sources tell Bloomberg a U.S. security panel has granted Nippon Steel permission to refile its plans to purchase U.S. Steel for $14.1 billion, likely pushing a decision on the politically contentious takeover past the elections in November. U.S. Steel up 2.5% right now. Nippon Steel, the ADRs, advancing by 1.1%. Again, recapping Fed Wednesday, we got you covered here on Bloomberg with the S&P up 5, up by about 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pellet, and that is a Bloomberg Business Flash.
All right, Charlie Pellet with a look at the latest figures when it comes to the markets. Thank you so much. Meanwhile, here in Washington, we're taking a look at the latest figures when it comes to polling as we consider how the Federal Reserve decision today may influence the minds of the American voter and consumer as they get ready to make a choice for president. And of course, it's the consumers and voters and a few states in particular that matter the most here as we consider the Electoral College and specifically the blue wall. We've mentioned the numbers from Quinnipiac, the idea that Harris is leading Trump in Pennsylvania and Michigan. Here are the exact figures. Harris 51 in Pennsylvania to Trump's 45. Jill Stein, yes, the third party that is a factor here, gets 1%. In Michigan, Harris 50, Trump 45. And of course, in Wisconsin, they're effectively tied, Harris 48-47. But that margin in Pennsylvania, Joe, might be giving them some cause to worry in the Trump campaign.
Yep, that's absolutely right. And just for the sake of disclosure, we're talking about a poll here, specifically in Pennsylvania, a sample size of a bit more than 1,300 people, a margin of error, 2.7 percentage points, smaller than the rest. So this is a pretty good number that we have here in Pennsylvania. It's where we start our conversation with Laura Davison, of course, helping to lead our political coverage and our campaign coverage here in Washington, D.C. Laura, it's great to see you. The top line numbers, the horse race numbers look pretty good for Kamala Harris, but specifically on the economy, a remarkable turn here to find her essentially tied, certainly within the margin, with Donald Trump on the issue that will likely, for most voters, decide this election. How did we get here so fast?
This is a really remarkable turnaround from where Biden was. He was trailing Trump in many cases by wide margins on the economy. Voters said they trusted him, Trump on taxes, on housing, on all these issues. And since in the past, 6-7 weeks, we've seen Harris put out different policies on taxing increases for the wealthy, as well as taxes for families, tax cuts for families. She said in in a speech this week that she wants to cap childcare costs at 7% of household income. That would be a major decrease in what many households are paying on childcare. You're starting to see voters warm up to her on her economic vision.
Well, so when we consider the contrasting economic visions here and frankly where the candidates have been, Harris made that comment on childcare in Philadelphia with the NABJ, one of the swing states, one of the key states we're talking about here. Donald Trump, meantime, is going to Long Island this evening to talk about the SALT cap, something that, according to the Committee for a Responsible Federal Budget, actually 92% of the benefits of that go to the top 10% of earners in states like New York and California, not these states that we're talking about, Laura.
However, the SALT cap is a big issue in New York, New Jersey, California, House districts that matter. So that's why you see him going there. This is not going to win him any votes. In fact, could potentially cost him some votes in some of these swing states where they say, look, why should we be spending money on, more state and local tax deductions for people who live on the coast when, I'm living in Nevada or Pennsylvania or Michigan, and, I need to see my, household budget go, get more relief. But this is also something that is important to Trump personally. One, he does would benefit from a SALT cap increase. Two, he has long held this dream of winning New York. That is highly, highly, highly unlikely. Harris is, up double digits in that state.
Although we should point out here, he is the one that put the SALT cap into place in the first place in 2017.
Does he need to explain that he's looking to restore a deduction that he caps, correct?
That is exactly
so
true.
What changed?
Politics, essentially, of, when in 2017, when he imposed this cap, this was one of the revenue raisers they had to offset the big tax cut bill. Yeah. And that's why you saw a bunch of New York Republicans vote against the bill at the time. As recently as 2019, Trump had said, oh, well, maybe we'll reverse that, realizing that the politics around this had been, quite heightened. You had, Chuck Schumer come out.
What Joe was talking about, this notion that we're seeing changes in the way voters feel about the economy or how the economy would fare under these candidates and Harris more favorably. To what extent do we think that is because they're talking about either subsidies or tax breaks, lower taxes, versus talking about this is realistically what the cost it's going to come from longer term when we consider our debt and deficit?
When you look across the board, and we did some polling, in our Bloomberg poll looking at, all of the expanded child tax credits, the down payment assistance, all of these different policies, they are widely popular no matter which candidate they're coming from. 75% of people support this. And this is what you hear on the campaign trail of, look, here are these tax credits, here's this tax relief that's going to come to you. Not at all of here's how we're going to balance the budget or reduce the deficit. The reality is probably neither of these candidates are going to do a lot to bring down the deficit. Trump has sort of ignored this as an issue. Democrats and Harris are still saying, look, we're going to pay for some of this new spending with tax increases on the wealthy, and corporations, but not doing a lot to bring down overall spending.
All right, Laura Davison, editor for our political coverage here in Washington. Thank you so much for joining us. And of course, as we consider these ideas that have been put forward, many in the media, including ourselves, strategists we've spoken with, Joe, have been talking about the lack of specific details from these candidates. The notion that we get these big headline ideas and not a lot of nuance in terms of how they would be paid for, et cetera. But I wonder if the polling is suggesting that voters don't actually need that. They like what they're hearing.
Yes, and why would you go there in a hard-hitting interview with a lot of policy details when you're clearly on the upswing here in the polls, not only overall, but on the issue of the economy? We're the ones who are asking, and her Republican critics, why aren't we getting more interviews? I wonder how many voters are.
Well, very fair. So this is a question we pose now to our political panel, our signature one at bat, Jeannie Shanzano, Senior Democracy Fellow with the Center for the Study of the Presidency and Congress, alongside Rick Davis, Stone Court Capital partner, both of them Bloomberg Politics contributors. Jeannie, first to you as the Democrat, someone we spoke for months about, Joe Biden's inability to get his economic record to actually register in terms of voter sentiment. Kamala Harris seems to have done a much better job of that in very short order. Is this a sign that her messaging is working effectively, that her ideas are ones that Americans actually do broadly support?
It is. There's two things that have happened. Number one, people were not satisfied that Joe Biden at his age and given what he had done in office so far could fight for them come in 2024. They wanted a new candidate and now they've got one. So that has helped her. And she has staked her claim on making the case that she understands the challenges people are facing economically. Every time she's asked about the economy, from the debate to the latest interview in Philly, she goes back to the fact she grew up middle class and she is going to fight for people like she grew up. So she's been able to do that, and she has sprinkled throughout there policies she would pursue. And you were just talking about one when it came to childcare. So those messages are effective. And I would just add that today is such an important day, in my view, for Kamala Harris's campaign. September 18th, Fed Day. They have got to do something with this day. Because while the markets and people who watch Bloomberg have factored in, we're going to see a rate cut, we just don't know how much. People more broadly, this is going to be very welcome news. And she has got to underscore the good news coming out today, the fact she's going to be there fighting for people, and the fact that Donald Trump's plan of tariffs is going to send us right back to inflation and more debt and deficits. She's got to make something of today. It's a big, big day for the campaign.
So, Rick, how would you capitalize on this if it was your candidate, Kamala Harris? Do you actually say, look, we've made enough progress on inflation that we've actually reached this point of a new regime. Your interest rates are going to start falling because of the work that we did at the White House. And if you're Donald Trump, do you also seize on this and say the only reason they're cutting rates is because the economy's slowing down?
Yeah, I think that there's plenty for both campaigns to do. And what's really amazing is how little each of them plan to do. Donald Trump is counter-programming the Fed by talking about the SALT tax flip-flop. I mean, I don't get that. I mean, you tell me. I know he's trying to win a couple of House races in New York, but how far off message could you be today? Yeah, we want to take $190 billion a year out of the tax code so that we can do what with it? More tariffs? I don't know. I mean, it makes no sense to me. And equally so, the Biden administration and Kamala Harris included refused to say the word inflation. Now they've got a story to tell, and today will be one of the key chapters in that story about how they fought it. But they just refused to admit there ever was any. I mean, they can empathize with people and talk about how, tough it is to buy a carton of eggs anymore. But for heaven's sakes, at least defend your own policies or at least take credit for them, because right now you got a little tick up in the Michigan consumer sentiment. People are starting to feel a little bit better. They're going to get a break here. As Jeannie said, maybe it's time to talk about, your home buying policy and how this will help reinforce that. But instead, I don't think she's doing any campaign events today. Didn't we know this was Fed Day a month ago?
Mm-hmm.
She's speaking at the Congressional Hispanic Caucus Conference.
Okay, sure.
Talking.
If you want to call that a campaign
she's
event
somewhere.
in Washington.
Yeah.
Right.
Fair enough, Rick. I also want to ask the question, though, as you talk about they now have a story to tell, this administration and the messaging we've gotten out of it. President Biden specifically has been very deliberate in not weighing in on Fed policy until the kind of very end, where he seemed to open up a little, calling for rate cuts and that kind of thing. But they have been trying to draw a contrast between themselves and the prior Trump administration, when Trump was tweeting at Jerome Powell and pushing for them to make moves on rates that he advocated for. We're still hearing similar things from him now. He thinks the Fed should have, or the president should have, say over Fed policy. Does Harris risk looking like she too is weighing in too much on the independence of the Fed if she tries to capitalize on a decision that they did make independently?
Look, I think, go ahead, Jeannie.
No, go ahead, Rick. I'll let you go. Sorry.
Look, I don't think there's anything they should hesitate talking about the Fed. I mean, obviously you're not telling them what to do, but the idea that you're, reacting to Trump working the ref so hard when he was president was a message to voters that he was willing to try everything he could to get the economy to do what he wanted to. And the fact that he had a decent economy before COVID gave him credit for that. I mean, this idea that somehow we can't even say the word Fed, and we can't talk about how it would benefit, a rate cut would benefit consumers, is silly. Why not? I don't understand that. They're plenty independent. You're not making this decision for them, but at least talk about it as a way to try and help consumers.
Or take credit for it, which is partly, I think, what you're supposed to do here in a campaign. Jeannie, there's going to be a news conference a bit later on today. Of course, Jay Powell's going to be speaking to different elements of the economy, and there are going to be questions about political motivation. Are you concerned about this looking like thumbing the scale if, for instance, we get 50 basis points?
I don't think so. I have to agree with Rick on this issue of how the campaign should handle it on the Biden or the Harris side. The reality is you need to show people that you are fighting for them. And if that means fighting the Fed, well, then go ahead, right? She has to take that prosecutor background that she has and say, I am going to prosecute this case on your behalf. Now, I do know that the media and certainly academics and others will say, was there a thumb on this? Is this a reflection of the campaign? But I don't think most voters care as much about that. If we are 50 days away, which we are from this election, get out there and show you are fighting for people in the middle class and that this is in their interest.
There's also the consideration here that this is the only time the Fed will get to make a rate decision, at least a scheduled one, before we know who the next president is, arguably. And they might not even know that when they make their next one, because they are scheduled to make a November rate decision just 2 days after the election. And if 2020 is any guide, we might not actually know who won in that case, Jeannie. So there's the consideration of how they might think about that as monetary policymakers, but also just where are we going to be on that Fed day in early November, 2 days out from the vote? Are you confident, Jeannie, that we will actually have a clear winner?
I am not confident of that. And I'm just thinking, Kaylee, that you and Joe will probably be going on 48 hours without much sleep by the time that
I think you're right.
I'm sorry to tell you that. But I do think that it is the reality that this was what makes this day today so important for these campaigns, is because we're not going to see another one till after. And I am not confident we will know who the president is. I hope we do, but given where we've been in the last 4 years, I can't feel confident about that at all. And especially looking at the polls and seeing how tight this race remains in every one of these swing states.
Rick, we've only got a minute left. Donald Trump has already said it out loud that cutting rates today is, quote, something they know they shouldn't be doing, unquote, before the November elections. Does the Harris campaign need to respond to that?
I certainly would. I mean, come on. He scuttled the best border security bill that we've had. He wants to shut down government, and now he doesn't want to give consumers a break on interest rates. I mean, there's your campaign. That's how you close this thing. You got 47 days. That's all I talk about. I mean, it's incredible that he would put all of these things behind his own self-interest. And so, yeah, I'd be all over it. I think it's crazy to take a position like that, including flip-flopping on SALT just so that you can get a couple of guys in Congress.
Wow. Well, we're going to have a lot to talk about here coming up in this news conference. Rick Davis and G.D. Shanzano, Bloomberg Politics contributors, our signature panel. Thanks for setting us up here and reminding us, Kaylee, that there are enormous political stakes here around this Federal Reserve meeting today, not only because of the timing, its proximity to the election, but it's the #1 issue on voters' minds.
Yep, absolutely. We're going to have more on that with Catherine Edwards just ahead, right here on Bloomberg.
121 on Wall Street. We do check markets all day long here at Bloomberg Fed. Wednesday, we've got you covered on Bloomberg Television and Radio. We've got just about 8 minutes to go until our special coverage kicks off. Stocks holding on to gains right to the numbers, with the S&P up 4 right now at 56.38, a gain of 0.1%. The Dow up 16, also higher by about 0.1%. NASDAQ up 11, also an advance of just about 0.1%. The 10-year now yielding 3.67%, with the 2-year 3.64%. Gold flat on the day, up just $1 the ounce to $25.70. West Texas Intermediate crude dropping 1%, $70.44 for a barrel of WTI. Bitcoin right now down 0.8% below 60,000, 59,667 on Bitcoin. Stocks, though, have been wavering amid uncertainties as to how aggressive the Fed will be with rate cuts after holding them at 2-decade highs for more than a year. Contract talks between Boeing and its largest union are set to continue after a first round overseen by a mediator left the labor side, quote, frustrated. Meanwhile, CEO Kelly Ortberg says the company will initiate temporary furloughs over coming days, and leaders will be taking pay cuts. Boeing shares little change now, up by about 0.1%. So again, recapping, S&P 500 index in a holding pattern right now, up 2 points, up less than 0.1%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. Balance of Power continues. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet in New York with a look at the trading just over half an hour out from this crucial Federal Reserve decision. Thank you so much. I'm Kaylee Lyons alongside Joe Matthew here in Washington, where we do know roughly 36 minutes from now, we'll have answers to a few questions. We will know what the move was, 25 or 50 basis points. We will know whether or not this was a unanimous decision, or maybe unusually, we might have dissents. We'll also know what the dot plot looks like, not just about this cut today, but what they expect to do over the coming meetings into next year. But the other answers will be left to one individual, Chairman Powell, when he takes the podium at that news conference 30 minutes later. And that's always where it gets a little tricky.
That's right, taking questions from the likes of Michael McKee, who'll be reporting a bit later on for Bloomberg, of course. And yeah, we're knocking the dust off a dot plot from June, I believe, with a major update today. And this is where we start our conversation with Catherine Edwards, economic policy consultant, writer for Bloomberg Opinion. Catherine, welcome back. It's great to see you. I think you're in the 50 camp. You can let us know. If that is the case, though, getting to Kaylee's reference, does Jay Powell need to have a unanimous decision?
I do wonder about what unanimity gives you when he has made very clear that the risk right now is to the labor market and not the fight against inflation. I mean, he signaled that pretty clearly at Jackson Hole. And so to have someone, not in concert, signifies to me either that they don't think the labor market as important, which would be upsetting, I think, to a lot of people, or they're signifying that he hasn't gone far enough. And they tend to, I think, kind of close ranks and come together around the big decisions to let everyone know that this economy is being steered, in concert.
So if we consider what he would have to personally message if the move is 50, because there is a narrative out there that a move of that size could signal panic, that they are seeing something that the rest of us might not be yet, that there is more reason for concern in the economy right now. So how important would his messaging be, frankly, in either instance, to explain why they felt the need to front load or not to front load?
Yeah, and I worry that if the message around 50 is, or the message around 25 would be, well, we just didn't want to play into market expectations, or we didn't want to think that people were panicking, of how much is the message around what other people will be messaging versus what the economy needs. And I think what I've seen in Powell over the years is that he tends to be very plain spoken about this was what the economy needed right now. And if we messed up, we messed up. If we went too low in the past, we went too low in the past, but it's about meeting the needs of the moment.
If we said transitory.
If we said transitory and we were wrong, then we were wrong. And I think a lot of people were expecting a cut. Last time they met, they didn't do that. So it is very possible for him to say, this is just what the economy needs. It's not panic. It's prescriptive, and this is good.
It's not panic, prescriptive. How about politics? This is the politics program. We'll hand things off to the market experts in about 5 minutes. Does he need to be deliberate about this issue?
I mean, I think the narrative is kind of forcing his hand there to say that this, they can't take an election into account. I kind of think of this as making a little bit of the James Comey mistake, working so hard to look like you're not in support of one person that you actively start supporting the other. You overcorrect. I mean, that's not a word that the Fed really likes, overcorrecting, but that it's definitely a possibility when you're trying to take into account politics. And what I would say is economics is hard enough. There's no need to bring politics into this decision.
So if politics don't factor into the actual outcomes from the Federal Reserve, that's not to say that what the Federal Reserve decides to do doesn't affect outcomes in politics, right?
Absolutely.
This is a decision that they're going to be making weeks ahead of a presidential election. So I guess the question is, to what extent do you expect that the actual beginning of the easing cycle will influence consumer sentiment if it is coming simultaneously with a slowdown in the labor market that might be felt first, knowing that even eased policy might have a lagged effect kicking in?
I mean, most people's impression of the economy is what they experience in their day-to-day lives, and whatever they read in the newspaper or see on the news, it's still just how secure they feel. Can they afford a home? Can they find a job? So I think, yes, the narrative that you can spin some type of narrative of like, oh, and here's DC conspiring to help people are going to say that, and then they're going to say like, oh, he didn't go far enough because they want to help Trump. I mean, that all of that is possible. I think the real question is, will people see an improvement in their lives? And if they don't start acting in the labor market's best interest soon, the answer to that is almost certainly going to be no.
If you're Kamala Harris, though, you're hoping for a psychological impact today. This is a good headline. I don't know to what extent she'll message that. Was one of the conversations we were having earlier. But how about in terms of a material improvement for consumers? This is a short period of time.
It's a short period of time, yeah. Maybe there's a mood boost to this, but it's 165 million workers in a pretty large economy. You don't get to take really dramatic right or left turns. And frankly, we don't want the economy to do that. I mean, we want to be on a steady path, and that can be really frustrating for people who want relief immediately. Just to say it's going to get better soon is cold comfort. So maybe people start cheering about how well the economy is doing, and that makes people more mad because they still haven't found their job. It's so hard to predict how an individual will internalize this great big economy that they participate in.
Well, and of course, one of the most immediate transmissions might be in mortgage rates in the housing market. This is selfish coming from me as I'm in the process of trying to buy my first home, and I'm like, rates go as low as possible, please, right?
Get down.
But that's where the dot plot will come into play, because those will start moving even before the cuts come if the expectation is there that rates are going to go materially lower.
Yeah, I think that if we can get built-in reductions to the mortgage rates, to get the housing market unlocked, to get people to be willing to sell their homes so that you can buy one, hopefully it's a great place. Can you just list off the specs that you're looking for here, and we'll telegraph that right to Pal. There's lots of relief coming, but I think sometimes we get a little bit upside down thinking in elections about what does one person want versus the other, and it's always helpful to remember that the housing market has been brutal for so many Americans for these past few years, and any type of movement, however it affects the election, is good for our economy, for people to feel confident that they can do something that they see as so fundamental as buying a home.
Should Kamala Harris today take credit for winning the war on inflation? It's the first cut. We finally made it.
That would be so foolhardy, but I would never put it past a politician not to take credit for something good.
I feel like her opponent might do that.
Yeah, well, that's different, right?
Well, I guess so. Finally, before we let you go, we just have a minute left. There's also the consideration of fiscal policy always, that the Fed doesn't have influence on, but they do have to react to. If we actually see the policy proposals, frankly, from both of these candidates coming to fruition, there's an argument that they would be inflationary and maybe cut this cutting cycle short. Do you agree?
Yes, I mean, we haven't seen, a lot of fiscal responsibility telegraphed from either candidate. We've got record deficits right now. We're not at an active war. We're not in an active recession. Deficits should not be this high. We have sabotaged our ability to collect sufficient revenue from the federal government. And at some point, we are going to need an adult in the room say we are not raising enough money. They're not going to say that 6 weeks before an election, but someone needs to say it.
Maybe Powell will today. Who knows?
That would be a moment.
That would be a moment.
We're looking for an adult in the room.
Great to have you on Fed Day. Thank you so much for joining us,
y'all.
Catherine. Of course, Bloomberg opinion columnist and an economic policy consultant. And we are now officially less than half an hour out, Joe.
This is going to be interesting. And of course, we'll invite everyone to join us at 5 p.m. The late edition of Balance of Power. Michael McKee will be with us to tell us the tale of what happened in the room. Special coverage is on the way, as you would expect, here on Bloomberg TV and radio. And we're glad you're along. A special edition of Bloomberg Surveillance. The Fed decides. is on the way with Tom Keene, Jonathan Farrow, and Lisa Abramowitz on Bloomberg TV and radio.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
Live on Bloomberg TV and radio, good afternoon, counting down to another Fed rate decision and Chairman Powell news conference. This one, just a little bit more important. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Farrow. Your equity market going towards an 8th day of gains, very close to all-time highs, 25 or 50 from the FOMC.
This is an incredibly different type of meeting than we're used to, and it is a monumental moment, the end of the latest edge of a cycle that has left interest rates at the highest levels that we've seen for the peak of a cycle going back to 2000. This is the first time in years that we've seen such a lack of decisiveness heading into a meeting that in the past was basically predetermined, pre-prescribed.
TK, it's a real live meeting. It's finely balanced. You've seen a million of these. This one just a little bit different.
I thought it was snooze fest up to Wednesday and things changed. And starting Thursday, John, it was completely different. Never seen anything like this. And to have Dr. El-Arian with us is fabulous.
It's going to be fantastic. I'm looking forward to it. We've got to talk about where the market is positioned as well. So check out the equity market right now. Very close to all-time highs. Going into this Fed decision. Lisa, that's the equity market. In the bond market, bond yields very close to the lows of the year.
And where we've come since the last Fed meeting really is rather remarkable. We came from a 4.3% level on the 2-year at the previous July Fed meeting. Now we're somewhere around 3.6%. A massive decline as people really front load this idea of Fed rate cuts. And it's not just the 25 or 50 parlor game that we've been playing for the better part of the past 2 weeks. There's also a larger question of what is the path going to be? Is it 240 potential basis points of cuts? Coming up this hour, Kathy Jones of Charles Schwab and Aditya Bahave of Bank of America Global Research. They'll be with us until the Fed rate decision at 2 p.m. Eastern. Then immediate reaction from JP Morgan's Bob Michael, Deutsche Bank's Matt Lazzetti, and Diane Swan.
Bringing together enough talent in one organization is really hard to do. And if you're working on a problem that, may be modestly successful, it's kind of easy to get the first few people to join. You can give them a lot of equity. But then it gets really hard. Why is employee 20 going to join? Why does this matter to the world? Why should someone work on your startup versus any of the other things they could do? And picking something that matters if you're successful is a great way to do that. And so I think it's really important to think about when you're starting the company, how is this going to evolve into a vision that a lot of people want to help with, that a lot of people want to be associated with? Because I think getting talent and getting mind share is really hard in the current environment, and people are interested in startups that matter. Another thing that we've noticed among our best founders again and again and again is that they have a confident and definite view of the future. They may be wrong, and so we say it's good to be confident and flexible, but this idea that you are confident and definite, this is what I think is going to happen, or this is what is going to happen, and being relatively sure of that, having courage of your convictions, being a clear leader, saying we're going to do this, and that's why, even in the face of a lot of doubt, that seems to really correlate with success. And this comes back to having an ambitious vision, but the entire startup ecosystem is best set up to support companies that have a low chance of success, but are huge if they work. And I think going for something that is huge if it works will attract the best people. I'm not going to talk too much about the team. There are a lot of obvious things I could say that have been said many times by many people about, you need smart people who want to work really hard and who communicate well. These are all really true. But I'd like to mention a few non-obvious things that we've noticed that we don't hear people say as much about the team you need to assemble. Vinod Khosla says that the team you build is the company you build, and I really think that's true. I've still met only a handful of founders, I think, that spend enough time on recruiting, like Mark Zuckerberg is famously one of them. But building a great team, I think other than picking the right market and building a great product is the most important thing you do. All founders go through a transition, all successful founders, where you switch from building a product to building a company, and building a company really is about the team. So you need optimists. The whole world will be telling you why you're going to fail as a startup. If you don't have that internal fire of belief, if you don't have people who say, you know what, we are going to do this, and it doesn't matter what the haters say, we're going to figure this out. And there is, this problem, it must be solvable. If you don't have the spirit of optimism on the team, it's very hard to succeed when the world continues to punch you in the face. You need at least some idea generators. There are a handful of people in any company that has gone on to be really successful that I've been able to work with who are just really good at coming up with lots of ideas. You don't want too many of these people because that's more ideas than a company can follow through on. But having some people within a company that are just constantly throwing out new ideas, most of which will be bad, turns out to be super important to have on the team.
They should have done 25, 25, 25, 25, and not be put in this position where whatever they do today, they're going to be attacked in a significant way politically from either side.
Couldn't you argue that it's a bit dramatic to say that the decision between 25 or 50 undermines the possibility of the U.S. as sort of the preeminent rate-deciding body of the world? I mean, at a certain point, they're going to cut rates. It's about the path that they are on. Yes, there's uncertainty about the size of the first, but not necessarily the pathway. Why is it so problematic?
So think of the image of you sitting on a beach and you're building a sand mountain, and you keep on dropping particles of sand, and nothing changes for a while, and then suddenly something changes due to one particle. This is not the first time we tell the rest of the world we're not a responsible guardian of the system. 2008, the financial crisis originated in the US. The phase of protectionism, 2017, originated in the US. The big transitory inflation mischaracterization originated in the US. So we have not been giving confidence to the rest of the world that we are responsible stewards of the system. And what you're seeing happening is little pipes being built around the system. Now, my hope is that the Fed will not be bullied into a 50 basis point cut. It will do 25 basis points. And I say this even though I thought they should have started last July. And the Fed will this time around come up with clear communication that gives us some notion of where they see the economy going and what are the policy implications, and not tell us we're all data dependent.
So you're saying that they could rectify their mistake if they come out and Fed Chair Jay Powell says, we're cutting 25 basis points, so-and-so dissented, so that we should cut by 50 basis points, and we're going to cut twice more by 50 basis points for the remainder of the year. Goodbye.
Give us a little bit more guidance in the data that's going to be published, but give us a sense of, first of all, are they a single mandate Fed? The market thinks they're a single mandate Fed. The market thinks it's all about maximum employment. The market has completely forgotten the second part of the mandate, and the battle over inflation has not been won yet. So first of all, are they a single mandate Fed, or are they a dual mandate Fed? Secondly, what does risk mitigation in this environment mean? They've got to be clear about this. The market now is basically pushing them more and more into a corner that they're going to find it harder to get out of if they don't regain control of the narrative.
So you've introduced the balance of risk question, so let's follow that lead. Is the biggest risk today cutting 50 basis points when we do need it, or rather 50 basis points when we don't? What is it?
For me, the biggest risk is cutting 50 basis points when we don't need it. That's why I would prefer to see them cut by 25 and have a clear path and stop this, you called it ping-pong narrative. Stop this ping-pong narrative. Regain control of the narrative.
What does regaining control of the narrative mean? You mentioned a single mandate central bank. It felt like Chairman Powell reinforced that view in his speech in Jackson Hole. Is there any reason to believe he won't go forward with that same theme later on this afternoon?
I don't know. He tends to flip-flop, so I don't have a sense for what he's going to put, but he did reinforce it. That phrase, okay, not the time has come and the direction of travel is clear. The phrase that we do not expect or welcome a further weakening of the labor market was a very strong statement.
That was a big change for this committee. And Lisa, I think a lot of people have felt like there is a theory out there. We talked about it earlier on this morning. The theory out there is that this is still a divided committee, and the chairman is looking to corner the other people on the FOMC into making a bigger rate cut decision in 20 minutes' time.
Which was the reason why some people speculated there was this informed article or two in a couple of journals to try to get other people on board. Question to me is, how vociferous is the argument on the other side with respect to the inflationary risks? The idea that Mohammed was just talking about, how 50 basis points of cutting at a time when you don't need to would be the bigger liability.
Working out how the bond market responds to this is complex. We talked about this a little bit earlier this morning as well, and I'm fascinated to see how this market responds to this rate cut decision in 20 minutes' time. Because, Lisa, at the moment, we've got equities close to all-time highs and bond yields very close to 2024 lows.
If there is a genuine argument that by cutting more aggressively now, you end up reigniting the risk of inflation later on, couldn't you argue that a bigger rate cut now would actually cause the long bond to sell off, yields to climb?
We'll have this conversation in about 5 minutes' time, and you'll see it in the real world potentially in about 18 minutes. Mohammed's going to be sticking with us through the hour into the news conference and out the other side. In just a moment, we'll catch up with Kathy Jones of Charles Schwab alongside Aditya Bave of Bank of America Global Research. Your equity market on the S&P 500 climbing for an 8th consecutive session from New York City this afternoon. Good afternoon.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The top names at Jackson Hole are on Bloomberg.
I'd like to see us move toward a more real-time data set. So using new technologies, maybe some of the AI technologies, maybe we get better data as we move forward, but we've got to really focus on that with our economists and our analysts about, where is the data coming from and can we rely on it?
Nobody covers Jackson Hole like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
The Fed is going to deliver. The question is how much.
We're in that 25 basis point camp.
25. It's really not a bad economy. It's a good economy.
Inflation, it's gotten a lot better. It is going in the right direction.
The data that we've gotten since Jackson Hole really hasn't screamed recession.
Is there enough room in the rate structure today for them to be aggressive? And absolutely.
There's a really good chance that they move 50. They should go 50, yes.
50 basis points at this meeting is, in fact, appropriate.
The Fed is way behind the curve.
There is a real risk the Fed is falling behind the curve here.
The downside risks to the labor market probably outweigh the upside risks to inflation.
If you go 50 first, the market will say, what do you know that I don't?
25 or 50, the debate of the last month. Hopefully this gets settled in a moment. It will in about 15 minutes' time, and then we'll talk about something else. The next decision on November 7th, 25 or 50. We'll do it all over again. Equities right now on the S&P 500 this afternoon shaping up as follows. 8 days of gains, up another 1/10 of 1%. On the NASDAQ 100 into this one, up 1/10 of 1%. If you switch up the board in the bond market, yields very close to the lows of the year. We're at 364 on 2s, Lisa on 10s, just short of 370.
Key question is, how much more can this market bake in. And you've raised this question all morning. How much is this market set up for disappointment? And what you saw throughout the session so far this morning, people trying to take chips off the table, kind of retracing just a little bit ahead of a decision that's been so fully baked in that people are now getting a little bit nervous.
Joining us now to discuss, Kathy Jones of Charles Schwab, alongside Mohammed Al-Aaron of Queen's College, Cambridge, still very much with us. Kathy, I asked this question to Mohammed. I want to ask it of you. Is cutting 50 basis points today when we don't need it worse than not cutting 50 basis points when we do? What's the bigger mistake for you?
Oh, I think not cutting when we need it is certainly more of a problem than cutting when we perhaps don't need it. But frankly, 25 or 50 to kick off this rate cycle, I don't think in the grand scheme of things is all that big a deal. We know we need a couple of rate cuts here. We know there's room for them because the Fed funds upper bound at 5.5 is very high relative to inflation. So, whether we start fast or whether we start a little slower, it's really more about how fast are we going and where are we going to end up.
Kathy, because Dr. Al-Aaron's with us, I had to go to logs. And the answer is I looked at semi-log 10-year real yield. And the answer is the vector's in place, the trend's in place, and there's even some convexity, some acceleration to a new lower real yield. Is that the outcome today that American, particularly American finance and business, resets at a lower real yield?
I doubt that it happens today because we don't have real economic data that's weak enough to suggest that we really need a much lower real yield, or certainly not one that's accelerating to the downside. I do think real yields will come down from here. There's plenty of room for them to come down. I doubt that today's the day that we'll see an acceleration to the downside.
Kathy, what do you think the reaction function is right now in markets in terms of both the short end and the long end when it comes to 25 versus 50?
My guess is the market is vulnerable at the short end if it's only 25, because we built in a pretty high probability of 50 at this meeting. So the short end would be vulnerable. If the Fed goes 50 and we don't really have a sense of, what their outlook is longer term, or it's unclear, then the long end might be susceptible on renewed growth and inflation fears. But I think that's a play for down the road. I don't think we're there yet. We have fair value in the 10-year around 375, 380. We have for a long time. So a little bit below that, but not so much that I think that there's a huge market reaction coming from a Fed meeting. It probably will come one way or another from the next set of data.
Kathy, as you know, it's not just about 25 or 50. It's the package. It's a three-part act. We've got a statement, a decision, forecast, and a news conference. I want to talk about the complete package here. If this is a low conviction meeting, how can we expect this Federal Reserve to provide any clarity about the outlook whatsoever? This is a market price for a return to neutral, not just 25 or 50 today, but a one-way trip towards 3 percentage points. And I struggle to see how we get a full understanding of where the Federal Reserve is going when they failed to commit to whether they were going 25 or 50 ahead of this decision. Are we asking for too much at 2 p.m. Eastern Time?
Yeah, I think we always ask for too much, right? There's some sort of expectation that the Fed knows what the path is precisely and will lay it out for us. I mean, I remember the years before there were press conferences or, announcements or anything. So I can harken back to times when the market was surprised by what the Fed did or didn't do. And I think it's sort of intellectually honest to simply say, here's what we expect, here's what we're looking for, here's what we're aiming for. But look, a lot of things change. A lot of things come up over time. They can't be expected to provide 100% certainty about what's going to happen.
Well, Mohammed, I look at this and I think John's dead on. There's more going on here than the silliness of 25 and 50 basis points. To me, the ECB does a dramatically better job of saying, here's our growth guesses. Are we going to see growth guesses today, or do they have conviction in what nominal and real GDP are doing?
I think you're going to see growth guesses, you're going to see unemployment guesses, and you're going to see inflation guesses. And there have been guesses because they have been proven consistently wrong. And this is the problem, is that even the forecasting issue has broken down. When I listen to Kathy, yes, Kathy, I remember those days as well. But the whole point of modern central banking is to avoid this unnecessary uncertainty because it can break something in the system. So going back to those days is going against a lot of central banking practice and theory.
Yeah, I think my point is really they have to be intellectually honest, and I think they have been. When Jay Powell is unclear, if the committee is unclear enough to not want to lay out a very long-term forecast, they'll say, this is just a forecast. We're driving down that foggy road. We're trying to go slowly so we don't run off the road. I think that that is providing a certain honest assessment that this is a very unusual cycle. It's not following any pattern that we're accustomed to. It is a global cycle. I think they've been pretty clear. We're headed lower. They want to get back to neutral. I think they have an estimate of neutral, which the market is pricing in. The speed maybe of the, are we taking the fast road or are we going to take the slow lane? Maybe that is in question right now, but I don't think that the direction or the destination, so far as it's been laid out, is really that unclear, at least as far as the market is concerned. So we have priced in a lot, and I think that that's a reflection of the estimates that we've had so far and some of the communications we've had so far. So, in an uncertain world, you can express uncertainty, and I think that that's okay. Markets can deal with it.
Hey, Kathy, it's got to catch up as always. Kathy Jones there of Charles Schwab. I'm so pleased we've started to talk about the ECB. This is old ground. We've talked about this a few times. But TK, can you imagine if this Federal Reserve in the next 90 minutes or so communicates in the way that Christine Lagarde has over the European Central Bank, as says things like, we're going to take this meeting by meeting. We'll offer you no guidance whatsoever about the next move. We won't commit to a thing. You can have 25 basis points today and we'll see you in a couple of months. This market would crater.
You're dead on. And the smartest thing I saw today was a single sentence from a guy named Alarian off some tweet. He had some free time or something getting ready for Jets Patriots. And Mohammed said, you know what? This isn't about us. He didn't mention the ECB, but he did mention the Bank of England and the Bank of Japan watching. This is a global meeting, John.
Mohammed?
It is, and I think what we're going to see this week is dispersion within the general theme of lower rates. So I suspect I know the Fed will cut today, the question by how much. I suspect the Bank of England will not cut tomorrow, and I suspect the Bank of Japan will hike on Friday. And just be a reminder that while we talk about a global cycle, there is dispersion within this global cycle.
Back-to-back decisions into Thursday, the Bank of England on Friday, the BOJ ahead of the Fed, 7 minutes away. Joining us now is Aditya Bave of Bank of America Global Research. Aditya, let's just start with the base case. What you're looking for from this Federal Reserve, the decisions, and the kind of changes to the forecast you're looking for in about 7 minutes' time.
Good afternoon. Thank you for having me. So we're in the 25 camp. I think Mohammed made the case a lot more articulately, honestly, than I can, but let me give it a shot and keep it simple. Before the blackout period, after the jobs report, the Fed nodded towards 25. That was our opportunity to tell us we want to go 50. They could have laid that case out. They chose not to. During the blackout period, the data we got were sticky housing inflation, solid retail sales, strong industrial production. So that should make the case for 25 stronger, not weaker. Obviously, we've gotten some nods towards 50. Those are from voices outside the Fed. I think it would be concerning for the Fed from a credibility perspective if they give the impression that those voices are now more powerful than Fed speakers.
That said, Aditya, some people argue that the Fed is far above neutral in terms of their benchmark rate, and that if they're going to cut and they're trying to get back down to neutral, given where inflation is, the slower they go, the more restrictive in a way they actually are. Economically, does that argument hold water to you?
It's a reasonable argument, and they could have made that case for 50, right? So here's what they could have said. They could have said, this is very similar to the mid-cycle adjustments of 1995 and 2019. It's just that we're significantly above neutral, as you said, Lisa, and so we need to come down in iterations of 50 rather than 25. If they had communicated that clearly, they would have potentially been fine, right? Now the risk is that the market keeps pushing you to do more. So if you do 50 today, everything could still work out fine, but the risk is the next time you get some weak data, and that's inevitable when the economy is slowing down a bit, the markets could push for 75.
Aditya, the economist Brian Moynihan 6 months ago lectured Jay Powell that just possibly the consumer may slow down. We're waiting. I'm talking 4.8, 5% nominal GDP. Is the consumer slowing down?
The consumer has been remarkably resilient. We had a bit of a softer patch at the start of the year, which is probably what was being referred to. But if you look at the last 3 or 4 months, even to our surprise, there's been a rebound. Retail sales over the last 4 months have just been very, very solid, right? So that's been very helpful, because usually what you would see in a labor-driven slowdown is that eventually the consumer collapses under the weight of labor income loss, and that's not happened so far.
Aditya, I understand the arithmetic that leads to the hypothesis that we are very restrictive because we're way above neutral. I don't know a single indicator of financial conditions that doesn't flash very loose financial conditions. So can you reconcile the two for us?
Yeah, I think neutral could be higher, right? So what do we know about neutral, really, to be honest? I think we can say with some conviction that it's somewhere between 2.5% and 4%. Beyond that, I don't think we can say a lot with conviction. So then it's going to come down to, we'll learn where neutral is as the Fed cuts based on what the economy does. And if they are able to soft land this economy, if they're sitting at 4% rates 3 months, 6 months down the line, depending on how far they cut, then I think the assessment has to be that maybe R-star has gone up. So even if the dots for R-star don't go up this time around, they might go up in the future. On the flip side, if we do go into a recession, which is not our base case, then you would say, okay, we were actually a lot more restrictive than we thought, and neutral is lower.
Aditya, appreciate your insight as always. Looking for 25 in 3 minutes' time. Aditya Bhave there of Bank of America Global Research. I'm pleased we got to this discussion. Equity markets close to all-time highs. Bond yields are low. Spreads are tight. Tight. We've had a round trip through the whole of August. And think about the demand we're already seeing for debt worldwide, across Europe, here in the United States as well, both sovereign and corporate. And look at what's happening with mortgage applications in America. Before we've even seen the first interest rate cut, we're already starting to unlock a lot of activity. Big move higher, TK. Big move higher this morning.
Which to me just highlights the reason why people treat the markets as though they're an adolescent looking for more, and you give them a little bit and then they're looking for even more. This idea that if the Fed says, fine, you guys can have your 50 basis points, then they're going to keep going with that, and that's going to create much easier financial conditions.
Quickly, Peter Warzak at Brookings with terrific 3 essays, Mohammed, on what the pandemic did to our microeconomics of our system. Are we still in the pandemic?
No, I think we've mostly exited, with the labor market being the last sector to adjust.
Do you think we're in bubble territory here? What do you think about some of these market moves? The fact we haven't even seen a rate cut yet, and we're already at these kind of levels.
I think we've gotten carried away on the fixed income side, both on...
Bonds more than stocks?
I think bonds more than stocks.
Why is that, Mohammed?
I think stocks, you can make stories for secular changes, for real transformational changes. I think in the bond market, you can't make that argument. If you make it, then you should go the other way, because we have fiscal deficits of 6 to 8%. We have high debt levels. The secular argument isn't in your favor in the bond market. 2 issues in the last few weeks. We've talked about them. We had debt out of Italy, record order book. The week before, we had debt out of the UK, record order book. We saw some of the busiest days we've ever seen in the high-grade corporate market in America. Tons of demand to back it up.
And when you ask people why, they say there's cash out there and people want to lock in yields before some of those rates go down. I love this story idea that basically you can come up with a story for stocks, but the story for bonds doesn't work logically with where it is right now. And that, I think, is the key. If you're storytelling, stocks actually make more sense right now than the story that is the bond market.
What did you say this morning? This is a market where logic comes to die.
Yes.
Isn't that what you said?
Yes, that is what I said.
That's my line of the month. My line of the month. This is the countdown to the Fed decision. It is literally seconds away. Going into it, your scores look like this in the equity market, firmer by about 0.1% on the S&P 500 on an 8-day winning streak. In the bond market, 2-year, 10-year, 30-year, your scores as follows. Your 2-year yield in America has been moving lower over the last month. Your yield 3.65. Your Fed decision with Mike McKee.
It's 50, and the promise of another 50 basis points in cuts by the end of the year, and another 100 basis points in 2025, which would put the nation's benchmark rate at 3.4%. It's projected to fall another 50 basis points in 2026, which would put the rate at 2.9%, which is now the Fed's median forecast for the neutral rate. That is up 1/10 from June. The consensus is GDP will rise 2% this this year, down 1/10 from the June forecast. Growth will be the same in 25 and 26. Unemployment will hit 4.4% this year. That's an increase from the June figure. It will fall to 4.3% in 2026. PCE inflation of 2.3% this year falls to 2.1% next year and hits the 2% target in 2026. Though inflation remains, quote, somewhat elevated, the statement says they cut because they now have greater confidence inflation is moving sustainably toward their 2% target, and the risks to inflation and the labor market are roughly balanced. While they do not explain why they decided on a half-point reduction, the statement says the committee is strongly committed to supporting maximum employment. And remember, in Jackson Hole, Chairman Powell said any deterioration in the labor market would be unwelcome. There was one dissent from Governor Mickey Bowman. It's the first dissent by a Fed governor since 2005. It is the first dissent by any member of the committee since 2022. The statement adjusted to say the committee will, as always, carefully assess incoming data, quote, in considering additional adjustments. There's no changes, guys, to the QT portion of the Fed's policy.
Mike McKee, stay close. We'll come back to you. Here's the price action in response to it. Knee-jerk reaction is the first move. Might not stick, but this is the move so far. Up by 0.8% on the S&P 500. The overwhelming outperformance on the Russell. The small caps now up by 1.7%. In the bond market, just bear in mind, we've come a long way, and we've priced in a lot to this yield curve. The 2-year just climbing just a little bit to unchanged at 360 at the moment at the front end of the yield curve. And in the FX market, dollar yen dropping back by about 0.7%. So that's a weaker dollar, a stronger Japanese yen. Lisa, 141 on that currency pair.
Yeah, now over to the Bank of Japan. And if they hike, how much does that divergence continue? I also want to point out gold. You're seeing a bid into gold right now. We start to look for some of the inflation proxies. So will this sort of feed into that idea? I thought it was interesting. The long end of the yield curve, just on the margins, not significantly, yields just slightly up on this idea that they're going to go bigger and potentially even more down the line.
So the median dot can mask some disagreement beneath the surface. So let's talk about the range and not just the median at the FOMC. The median dot for 2025 in the projection materials that were just published is 3.4%. The range for 2025 is anywhere from 2.9 to 4.1. 2.9 to 4.1. That's quite a range on this FOMC. And I think for the first time in a long time, we have some dissent playing out publicly as well. The first dissent from a sitting governor on the FOMC since 2005. This was not a unanimous decision.
And it really highlights why this actually became such a knife's edge kind of decision. Just to add to that, 10 officials penciled in 100 basis points or more of cuts for this year. 9 officials penciled in 75 basis points or less for this year. It actually matters quite a bit for market expectations, especially given some of the policy uncertainty next year.
So TK, we get 50. We get 50, and now we're waiting for the next act. It's a news conference in 26 minutes' time.
I think it's a surprise. Within the zeitgeist, this is to the edge of surprise. I think Powell maybe alluded to this with his enthusiasms at Jackson Hole. You touched on something Jason Furman touched on this morning, which is don't forget the dollar. And Mohamed El-Erian, I'm going to be as direct as I can, is the great unknown here a dollar weakness that anybody without great hair doesn't know?
That we may not know. I think we've seen it before. I remember periods of dollar weakness. But it is dollar weakness. This is not just a 50 basis point cut. This is a dovish 50 basis point cut.
Well said, yeah.
Right? I mean, now, I agree with you, John, that the dovish part comes from the median dots. But if you look at the range, it doesn't look at dovish. But that's not what the market is going to hear. The market is going to look at the median dot and will interpret this as a dovish 50 basis points cut. And the first reaction was actually steepening of both 2s10s and 2s30s, which tells you something about what people are worried about.
To some extent, this median dot validates market pricing coming into this decision. Is that sufficient? I'm looking at equity market reaction right now. We're up by 0.5%. We've still got a news conference, a question we've asked for the last several weeks into this. Are we going to end up with disappointment on the other side of this news conference with Chairman Powell? What would your question be now?
So first of all, normally he's more dovish than the statement. So that's going to be pretty hard to do this time, but let's wait. My question will be, what has changed since July when you decided not to cut rates? And now there's this very aggressive cut and aggressive signaling. What has changed?
The speech in Sintra, Portugal at the start of summer, very different to what we're hearing from the FOMC just several months later. Joining us now to discuss is Bob Michael at JP Morgan Asset Management. He joins us out of London this afternoon. Bob, we just want your first impression to the decision. What do you make of it?
It hit on pretty much everything we were looking for, probably a little less dovish than we thought in two instances. One, there was a dissent, so it wasn't a slam dunk, and we would have liked to have seen the median dot for the end of next year somewhere around 2.75% to 3%. But otherwise, as we had been guided over the last week, nothing to quibble about.
Bob, which bond series or individual bond provides the most information right now? Is it a real yield? Is it the nominal full faith and credit? What's of the most value to Bob Michael right now?
Credit spreads. Credit spreads will tell us whether investors believe the economy is in dire shape and this was an emergency 50 basis point cut, or whether this is just a Fed a long way from neutral, perhaps, as Mohammed hinted, a meeting or two away from where they should have started the cycle, so they're starting to get towards neutral. All is well.
Okay, all is well. And yet what we saw earlier this morning was an increase in mortgage applications. What we've seen is already the bond market pricing in all of this and then some, and basically this statement only encourages that even more. Do you not see a risk of potentially reignited inflation, Bob, that we could potentially see expressed in the long end? As Mohammed was mentioning, we are seeing that yield curve steepening in a way that hints that something else is amiss, especially when paired with gold.
Whoa, whoa, whoa. We're a long way away from that. We're looking at the 3-month annualized rate of core PCE running at 1.7%. So that's not inflationary. There's signs of disinflation everywhere. When you look at the labor market, they talked about full employment. Well, the low in unemployment was 3.4%. A couple months ago, it was 4.3%. That's up 0.9%. You only see that when there's threat of recession. That's characteristic of that. They've highlighted to us that the neutral Fed funds rate is somewhere around 3%. That's a debate we could have for a long time, but it's nowhere near 5.25%, 5.5%. So they can start taking pressure off of businesses and households without reigniting inflation.
Bob, I know they call you Bob Michael, but you told me earlier it was Bob Michel, so I'm going to stick to Bob Michel. Bob,
Mohammed, I came to London because I thought we were going to QPR Millwall on Saturday. Now you're in New York on me?
I'll be in London tomorrow.
All right.
So Bob, speak a little bit to the revisions in the projections, and particularly unemployment. What do you make of that?
I didn't catch them. What did they do?
They pushed it up.
Yeah, I think they have to. I think they have to acknowledge that we're at a challenging time, that there are new entrants to the labor market, but those are still unemployed U.S. workers. And they have to acknowledge that we're not below 4% anymore. We're heading a little bit higher. And that's why you need the policy response to start with 50 basis points. I'm okay with that.
Yeah, but Bob, I think we've got to talk about this a little bit more. And I'm pleased we went to unemployment. Unemployment right now in America is at 4.2%. These are the Fed's projections out in 2024 year end, out to 25 and beyond. They've got projections of 4.4%, the median projection for unemployment this year. Next year, they've got it at 4.4%. Given the move we've seen over the last 12 months, Bob, how aspirational is that? How realistic is it that we just kind of pause around these levels for the next 18 months?
Well, we very well could. If we get 225s over the next two meetings and we bring rates down 100 basis points, what we know is there's still a shortage of housing. There are first-time home buyers queued up to buy homes. So bringing rates down could bring those buyers into the market. We also know that a lot of businesses don't fund themselves in the public bond market. They fund themselves through bank loans, through private credit. Those are floating rate loans. Those are anywhere starting with SOFR at 5 3/8%. You take 100 basis points off of that, that could help to stabilize things as well. Just because unemployment has headed up over the last year doesn't mean it has to keep going. It can certainly flatten out here if the Fed does its job.
Hey, Bob, appreciate catching up as always. Bob Michael there of JP Morgan Asset Management. There's a couple of moves in this market that I think are very, very interesting. We've just gone 50, and in some ways the dot plot is validating what we were pricing in this market ahead of time as well. And what you're seeing at the long end is the long bonds sell off and yields climb by 2 basis points. It's not a big move, but it's notable. We're up by 2 on 10s, on 30s we're up by 3, and at the same time we've got gold at all-time highs. What is this market sniffing out?
Well, it's sniffing out on the margins a greater inflationary risk than otherwise priced in. Look, I could make an argument about how it might mean that we're going to suddenly get run away into 70s-style inflation. That's not what it's saying. But what it is saying is that on the margins, the idea of a bigger and, frankly, a dovish 50 basis point rate cut really highlights how inflation is still back on the table, at least on the margins.
They're talking about a dual mandate imbalance. Mohammed, your impression is that it's a single mandate central bank now. And you don't think we should take our eyes off the other side of the mandate. Do you think the market's speaking to that, just on the margin, this afternoon?
I think at the margin, yes, but I do think that this is the reaction of a single mandate Fed right now, especially if you believe 2% is your inflation target.
Let's cross over to Diane Swank and bring her in of KPMG. Diane, we'd love your thoughts on the decision, and then we can get into the nuances. What do you make of the 50 instead of the 25?
This was a huge victory for Jay Powell, who really laid out at his Jackson Hole speech that he was worried about employment. And that is what this is about. And Mickey Bowman doing a dissent, Powell willing to take a dissent among the board members as opposed to among a president. That is how much he wanted this 0.5% rate cut. And I think that's very important. I think you're going to see it couched and explained within the context of several participants at the July meeting thought they were ready to go ahead and cut. So this is a bit of a catch up to that. And so that should help temper a little bit this dovish read on it. I was surprised that they kept the risk balanced, although clearly the focus is now on employment and not allowing the situation in employment to become much worse. Remember, we're at 116,000 payroll gains, 3-month moving average as of August. That's not statistically different from zero. Combined with the downward revisions we saw on August 21st, the day before Powell gave his remarks at Jackson Hole, those downward revisions, record downward revisions, even if they're not as large as they appeared because of some immigration that we're not capturing, they're still large, and it means the birth and death rate, the death rate of firms has picked up, and their small businesses aren't hiring as much as well, which could mean actually the payroll data for this year also gets revised down, and that's what they're worried about.
Diane, your work out on LinkedIn has been just hugely beneficial, a really holistic view of the U.S. economy. I have a Dow Jones Industrial Average, bottom of the pandemic, up 128%, 21% per year. I've got debt and deficit that Hal Bronner and Bernstein never dreamed of. Diane Swank, is this a Fed just dealing with our stimuli? Is this a Fed just dealing with debt and deficit to the sky?
You know, we've had everything you could possibly imagine pushed up inflation, and now we're seeing it come down despite the fact that we still have a lot of debt. So, you know, on the margin, yes, we do have high debts, and I do believe we need to deal with that at some point in time, and I don't think we have anyone who's willing to talk about it on either side of the aisle, which is another issue, and we can talk about that at a later date. But right now, we've got a Federal Reserve that's no longer buying that debt, and you've got a Federal Reserve that is seeing inflation come down despite the fact that we have high debt. And that's because on the margin, after we get past the sort of 6 months that we put a whole year budget into, from March into October 1st, you get a continuing resolution at best through year end, and you're going to get more constraints on spending, I think, as we get into 2025.
Diane, one reason why this comes as a surprise, this decision, one reason why is because they could have telegraphed this more carefully. There was no data that really moved the needle between the time when the quiet period began and now that would shift us toward 50. Why do you think there wasn't more clear communication that this was a Federal Reserve ready to cut rates by 50 basis points?
Well, frankly, I don't think that Jay Powell, by the time the blackout period hit, had the votes in his pocket to be able to do that. And I think we saw that in some of the mixed messages, even the day of the blackout period. Chris Waller, governor on the Federal Reserve, had said, you know, you'd be open to a more aggressive rate cut, but he didn't seem to be really ready to do it in September. We saw John Williams come out that same day and sort of talking about more cautious rate cuts, more of a quarter point kind of rate cut. So they didn't telegraph it because he hadn't corralled the cats, but this really does speak to the fact that he does have an extraordinary ability to actually do just that.
Let's get to this quote from Neil Dutta of Renmac, just out at the moment. Here's the issue. The balance of risks have changed. In June, most saw balanced risk to unemployment rate. Now, this has completely flipped. Most see risk to unemployed skewed to the upside. This will not be the last time we see a 50, in our opinion. Lisa, your thoughts?
This is basically what's being priced into this year. I mean, how else do they get to more than 100 basis points potentially by the end of this year? And if you think about it, it raises a lot of questions about what they are seeing that suddenly makes that such a consensus, given that we've gotten a lot of mixed messaging.
Let's head back to London and catch up with Bob Michael at JP Morgan Asset Management. Bob, I'm sitting there in cash. I've been sat here for a long time. You've been warning me for a long time that I face real reinvestment risk. The Fed's just cut 50 and I'm freaking out. I give you a call. I'm now worried about another 50 and maybe another 50 after that. What are you buying on my behalf?
We're telling clients, just get into the bond market. Just get into a general bond fund. It could be an aggregate investment grade bond fund. It could be a core plus bond fund. If you're in a high tax bracket, get into a general municipal bond fund. Yields are coming down. Yields are at this level with $6.3 trillion in cash building up and most people not liking the bond market. Some buying has brought it down here. And this money will come in because they're going to watch the return on cash go down like power windows.
I got to say, Mohammed, this goes to the point that you were making. I love your comments on this idea that the Fed was seeing something that made him shift his view, and what we're seeing right now is that maybe he just didn't have the votes. I'm just trying to wrap my head around what that means going forward, that maybe they're going to be even more aggressive than the market previously thought, and that maybe it is appropriate to price in even more spread compression, even more yields going lower.
So it would not surprise me if that is the market reaction. It would not surprise me at all, because the market has been conditioned to ask for more and more and gets more and more. So it wouldn't surprise me if that is what happens. I will go back to the significant dispersion in people in FOMC members' view as to what the destination looks like. And that dispersion has got to be reconciled over time. So I don't think it is as clear-cut as the market will make it seem.
Diane Swank, I got 8 ways to go here. Let's try this. You've got a wonderful reading of America away from 3 zip codes in Manhattan, the quadrants of Washington, D.C. This rate cut, how does it affect America that are not the elites, not the people enjoying NVIDIA to the moon?
Well, this is really important because the rate cuts, the short-term rate cuts, are what come through on loans that consumers take out. This is beyond the mortgage rate situation. This also helps the mortgage rate situation, obviously, but the real issue for consumers are short-term interest rates and how they are priced on their debt. Now, on the credit cards, the average credit card rate is about 25%. This is a rounding error on that. It's not going to help a lot on that. That's just incredible how high those rates are. But when you get into auto loans, when you get into other kinds of loans that consumers take and businesses, middle market through small businesses, it affects all those loans. And right now, you can imagine a lot of people are going to get some relief in terms of that. Now, the good news is there's not a lot of overhang of debt for consumers, and they can service the debt they've got. But for those lower income households that have already exhausted all of their savings and then some, this is good news. They rely on lower rates to buy used vehicles. They can't even afford to buy new vehicles anymore. That goes right up into middle income households. So that's where we'll see some movement, but it's not immediate. You're not going to see, the Fed also understands there's lags. And I think Mohammed is right about the issue of the market front running when the real message here is that this was not not signaling that we're ready to cut. This is a window of opportunity to cut now, catch up on July. That's important. But this isn't a signal that they're ready to go 0.5%, sort of continuously. And the election is an uncertainty. That is not factoring into the decision today, but it is an uncertainty in terms of policy for 2025 and 2026. And that could change the trajectory for the Federal Reserve once that cloud of uncertainty regarding the election outcome in the U.S. is lifted.
Could not agree more. Dan, just one of the best as always, the clinic. Diane Swank there of KPMG. November 7th could be a very, very different meeting. If you are just joining us, welcome to the program. 25 or 50? We got 50 from this Federal Reserve. The outlook? Unclear. 10 out of 19 officials favouring lowering interest rates by at least an additional half point over the remaining 2 meetings of 2024. And the next meeting in 2024 could be very interesting if we do indeed have in hand the outcome of the presidential election. Matt Lazzetti of Deutsche Bank joins us now for more. Matt, your first reaction to this one, please, sir. We get 50.
Yeah, I think it's all about the messaging that we hear from Chair Powell about the reaction function as we look ahead. You know, as we were thinking through if they go by 50 basis points, what is the communications challenge for them? I think it's 2 things. One, they have to project confidence in the economy, positivity in the economy, so they avoid a negative confidence signal. And then 2, I think that they want to send a signal that this is not the new norm, that they're going to be ratcheting down to 25 basis point increments. And as I look at that dot plot and the skew for this year, it does seem that there's a pretty strong kind of consensus around going 25 basis points from here. I think 18 out of 19 dots showed only an expectation of 2 more 25 basis point rate cuts or less. And so I think Powell can paint this as a one-off. It was meant to right-size monetary policy to a lower inflation environment, ensure that the real rate doesn't rise too much, and to really show that kind of actions speak louder than words in providing confidence on the soft landing.
Matt Lazzetti, the 10-year real yield just printed below 1.50. To me, that's a huge signal coming out of the pandemic. What does a diminished real yield do for American business, American finance, and investment?
Look, I think we should expect that the goal of this is to keep financial conditions easy, to ensure that financial conditions don't over-tighten and put a soft landing in jeopardy. That is ultimately the legacy of Chair Powell, and I think that he took out some insurance against that today. I think that's a good outcome for the economy. Hopefully he can message it in that way, which is they have a positive outlook. This is not the starting of a 50 basis point cutting cycle. And I think if you get that, soft landing prospects improve, financial conditions ease, and we have a very good outcome for the economy.
Matt, one of the stickiest areas of inflation has been the housing market. And what we've seen there has been recently an uptick in mortgage applications, as well as just in general, some of the home lender stocks. How quickly could you see a transition from a market that is completely flat on its back, not shifting around, moving at all, to one that is robustly price discovering to the upside with people given renewed confidence by lower rates?
Yeah, you know, we got mortgage purchase applications this morning, and they did show a tick up, more driven by refinancing activity than purchase activity. It does seem to be lagging a little bit, the move in the mortgage rate so far. My own view is I think that's driven by, when you look at the University of Michigan or Conference Board, so many consumers expect rates to come down over the next year. And so that has to happen, and maybe as rate cuts happen and as mortgage rates fall further, that really does unleash activity in the housing market. That would present upside risks for the economy. You know, I think the reality is Q2 growth was 3%. Q3 growth is tracking near 3% according to the Atlanta Fed GDP. When you look at consumer spending on a 3-month annualized rate, it's the highest that we've had since 2011. We got a robust retail sales report this week. So, you know, I think Chair Powell should present a picture where the underlying economy and fundamentals are resilient and strong here, but they were taking decisive action today to ensure that those outcomes continue.
Hey, Matt, final round before you go. Question for the chairman in this news conference. What's your number 1 question?
I think it's all about reaction function. So the fact that they went by 50 basis points today before seeing very weak outcomes for the economy will naturally raise questions in the market about what if you get a weaker jobs report? Do they go by 75 basis points or not? So I think it's all about the reaction function from here. And, you know, how does he respond to that? Does he kind of set a high bar either for another 50 basis point or even higher rate cuts?
Matt Lazzetti at Deutsche Bank. Bob Michael at JP Morgan Asset Management still with us. Bob, you love asking this one too, so I'll ask it for you. What's your question for Mike McKee in this news conference a little bit later on this afternoon?
Has the concept of an equilibrium, long-term neutral Fed funds rate expire? Do we need that anymore? Shouldn't they be talking more in terms of a real Fed funds rate, maybe minus 1% to plus 3%? I mean, for goodness sakes, in my career, I've seen the Fed funds rate at 0 and 20%. So trying to target something like that is nonsensical to me.
Hey, Bob, got to catch up as always. Bob Michael at JP Morgan Asset Management. We get 50 from the Federal Reserve. Your news conference is 5 minutes away. The price action looks like this, up 0.5% on the S&P 500. In the last hour, Lisa printing a new all-time high on the S&P.
Which really is in line with what some people were expecting, although disappointment they did not get. If you want to take a look at whether this is a Fed that can outdove market expectations, it seems like they did. And the projections going forward really highlight how this market likes to run ahead of even where Fed pricing is. Just look at this. If you take a look at Fed fund future pricing, we're actually pricing in a 4.1% Fed funds rate to end this year. So we're talking about an additional almost 100 basis points of additional cuts from here, 150 basis points of cuts, which just, again, points to why a dovish 50 basis point cut has made a difference in this market.
Mohammed, you alluded to this. If they go 50, the pressure will build to go 50 again. Is that what's happening?
That is what's happening, and the market loves this. And it's been the repeated conditioning of the market. Give it something, it will want more.
I look at this late in the press conference, John, when we get to the political questions. Like if I was to parachute John into the Alarian Institute of Behavioral Economics and Policy.
Would you behave?
The first, I would behave, and the answer is there's 2 United Kingdoms out there, and there's 2 Americas out there, and he has to address within his neutrality and the political debate those 2 Americas. It's not just about Bob Michael and the portfolio on Park Avenue trying to figure out what to do next.
How does he navigate some of those issues, Mohammed? How difficult is it to set policy for 2 very different experiences in this economy?
It's very difficult. It's even more difficult when politicians are shouting,
go 75.
Go 75. No, it is really difficult. What's not clear to me is if he is actually buying insurance, what is the cost of that insurance? What is the downside of buying insurance? You know, insurance is hardly ever costless. So what is the downside of having bought insurance for the economy? And that's something we'll only find out over time.
Well, what's the cost of buying insurance for the economy, but also for the Fed and for its political independence and its reputation therein? I just wonder if it's more difficult to make the decision now on November 7th, now that you've had this initial 50 basis point rate cut, and you have a market that's now saying, yeah, you could do another one in November.
Yeah, and that was the argument all along. Start in July. Don't get yourself in this situation. But it is what it is, and they're now going to have to navigate this. I think Powell is going to be very clear. He'll say we are not impacted by political issues, just like he will say that he is blessed, to use his word, by lots of opinions from outside. But ultimately, it's what they decide in that room.
And they will get lots of opinions after this one. In just a moment, 2 minutes away, Chairman Powell will walk into that room and give us a news conference for the next 60 minutes or so. We'll take that in its entirety on Bloomberg TV and on Bloomberg Radio. Lisa, things could be very different on November 7th. We've said that repeatedly. I don't think you can overstate it. Things could be very different. The outlook for 2025 could shape up in a rather different way, dependent on what the complexion of Congress looks like, how divided things are in the nation's capital.
And whether or not we even know at that point, as Anne-Marie likes to say, whether we have a decision. It just will be interesting how much, this is the 3-part act, we get the 3rd part of the act coming up moments away, how he characterizes what this insurance policy is really for. Is this because they are seeing true weakening in a labor market that otherwise is kind of hanging in there? And that, I think, is one of the key questions.
How do you expect him to frame it? Is this a one-off mid-cycle adjustment, a wait and see, we'll regroup in November? Or is this the beginning of a one-way trip back towards what they think is neutral?
Could it be both? I mean, right? Is there's basically, can everyone have their cake and then eat it too? Because essentially you have inflation coming down and you have an economy that is in a trajectory that typically does lead to further weakening. Is it history that can actually make sense at a time that has defied a lot of historical precedents? It's going to be a really difficult one for him to really
It's going to be difficult because they're coming out of a pandemic and they're making it up every meeting and every day and every speech, John, as they go. They're making this up as as they go. Today, they catch up, maybe, is the right way to put it. But the then what of November and into 2025 is real.
We certainly all agree on that. We've said this a few times. We've all been humbled through this pandemic and coming out the other side. Equities right now going into this one just short of all-time highs on the S&P 500. We are firmer by 0.5% in the bond market. This is the yield reaction. On a 2-year, we're down 4 basis points going into this news conference. Just remember, for 7 consecutive Fed decision days, this 2-year has rallied. This yield has dropped, and that continues at least for now. We're down 4 basis points at the front end of the curve. The chairman of the Federal Reserve, after cutting interest rates by 50 basis points, takes the floor.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you weren't thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50? And how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the two employment reports, July and August. We've also had two inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. So we took all of those And we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members rather of the committee are thinking today, assuming that their particular forecasts are realized.
Hi, Chris Rugaber, Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher than Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2%. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut and left it open. And I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So there is a dissent and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year? For example,
we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina. Hi, Chair Powell. Gina Smilik with the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions there. So I would say we don't think we're behind. We do not think we're behind. We think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. Sorry, your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018-17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, the retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment, disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person, as measured. It's now around 1, but that's still a very good number, I would say. Quits have come back down to normal levels. I mean, I could go on and on. There are many, many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change, particularly over the last few months. And, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
More data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. On the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. It's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil. Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payrolls the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed the unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I think we are. It's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5%, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, and you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But, honestly, we're going to find out. But, it feels to me that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. We only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so, this is my fourth presidential election at the Fed, and, it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve. And we do that, and we make a decision as a group, and then we announce it. And that's always what it is. It's never about anything else. Nothing else is discussed. And I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And, it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels. But they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this. But, the direction of travel is clear. And as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just one or two cycles of annual lease renewals. So I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more difficult. And, where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guido with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, business people who are actually out there doing business. So I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not. That doesn't really answer the question that we ask ourselves, which is let's look. At this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout. And all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation. And when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And, of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, could you talk, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan.
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But, in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so importantly?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea. It is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
Let me we'll give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Okay. And is there a date for that?
It's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
And then yesterday there were merger reform finalizations from the other bank regulators. What does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. Even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. That the stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look. Well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a downturn is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No. Thank you.
That wraps up a news conference that probably should have wrapped up 15 minutes ago. Live from New York City this afternoon. Good afternoon. For our audience worldwide, welcome to the program, a special edition of Bloomberg Surveillance on a Federal Reserve decision. The decision as follows: a 50 basis point cut with a sprinkle of dissent. Your equity market on the S&P 500 still just about firmer, but rolling over in that news conference. We're now firmer by just 0.25%. On the Russell, still elevated up by more than 1 full percentage point. Straight out of the gate in that news conference, framing policy recalibration, something he said multiple times, a process that evolves over time. Take a listen to what the chairman had to say on the path forward.
I do not think that anyone should look at this and say, "Oh, this is the new pace." You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the S&P. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level, and we're moving at the pace that we think is appropriate.
Recalibration on repeat. Lisa, looking forward, meeting by meeting, this is not the new pace. That's something he put some weight on, some emphasis in that news conference.
And if you were basically judging his news conference based on the stock reaction, there was a little wobble after that statement, and even more of a wobble after he really addressed the idea of a neutral rate. He called it a sense of neutral, whatever that may be, and he said that my own sense is we're not going back to that Nehru time or that negative rate, very low rate time. Neutral rate is probably much higher. You saw a reaction there, but then people shook it off and said, hey, he's got our back.
I look, John, I strapped a Fibonacci across this, so from where we were to the midpoint of the pandemic low is 2 7/8. He is correct. It's just a nudge in the distance to travel just to get back to the midpoint, call it normal. It's a lot longer than the jawboning in the press conference that we just saw.
We're lucky to have Mohammed alongside us. He won't say mission accomplished. He refused to say it in this news conference, but we've got to ask, isn't it implied? Listen to this. The labour market conditions are pretty close to maximum employment. Retail sales, GDP show the economy is growing at a solid pace. We're not seeing rising layoffs or hearing it from companies. It's time to support the labour market when it's strong. That's what we're trying to do. Is that mission accomplished? Isn't it implied?
Yeah, I mean, Jason Furman put it as well as anybody can when he said, if you look at the projection, and now if you listen to the statement, it is, and I'm quoting him, just about the closest thing to mission accomplished banner that you can imagine them unfurling. So I think it is. The hard thing for Powell is that we're not just recalibrating policy, we're recalibrating what we mean by a 50 basis point cut. You don't start a 50 basis point cycle with a 50 basis point cut and say at the same time the economy is in a good place. And that's what he had to navigate all the time. If the economy is in a good place, why are you starting with 50 basis points? And it was harder for him to reconcile the two because he didn't want to acknowledge that keeping rates unchanged in July was a mistake. So that's the tension that played throughout the press conference.
He did mention that if they had that jobs report before that meeting in July, that maybe they would have gone 25 at that meeting. What did you make of that?
I made of that this idea that what does he mean about the totality of data? And he didn't talk about data dependency in quite the same way. When he was asked by our own Michael McKee about what he was looking for and how much he seems to be reconciling something, he didn't have a really clear view on that. What is the data we're looking at now? Is it basically revisions to the jobs numbers that we're getting, as well as potentially the beige book?
You've said this a few times, revisions. Seems to be more weight now in revisions. And I think over the last few news conferences now, he's basically said whatever payrolls is, he thinks is overstating jobs growth in this country.
Which has been just the truth over the past couple of months and frankly more than a year. Typically when you get a weakening labor market, the data that you get initially is stronger than what you get on the revisions downward. But just to build on the idea of mission accomplished, he kept saying that the only reason he could really make a commitment to 50 basis points is we are committed to coming up with a good outcome. He came up with lots of, he went to the thesaurus about soft landing, but that was really where he was heading.
Joining us now to discuss, to continue the conversation, Bill Dudley, the former New York Fed president, and Bloomberg economics senior advisor. Bill, in your piece before this decision on Bloomberg Opinion, you said the Fed should go big now. I think it will. It did. What did you think of what you heard this afternoon?
It's pretty much what I was expecting, in the sense that one of the issues that Powell had is how do you do 50 without scaring people that you know something bad about the economy. And I think he did that very well. He basically said, we're doing this because the news is good. We've made progress on inflation, as opposed to we're doing this because the news is bad. So I thought it was a very, he's providing reassurance to people that the Fed thinks that they've got it. Also, when he's asked about, the SOM rule and the risk that the unemployment rate could go up by quite a bit more, pretty reassuring on that. Thinks that the labor market can stabilize close to where we are today, and that's really hugely important because, if the labor market doesn't stabilize, then we will have a mild recession. And then the Fed will have to ease a lot more. So I thought the general tone of the press conference and the statement was, we've got that. We've got it.
Bill, congratulations. Your essay today, you think you were one of the Fed whisperers everybody's talking about out there right now. Bill Dudley, I look at where we are and where we're heading, and it simply comes down to the strength of the American economy. Forgetting about the theater of recession, where does GDP settle? Whether real GDP or nominal GDP, how do you envision that in a year or even 2 years?
I think if you look at the Fed's forecast and look at how that growth affects the unemployment rate, the Fed thinks that, growth in the medium term is going to be 2% plus at an annualized rate. So, and that's sort of what we're doing right now. So, the Fed's got a sort of soft landing in place. If the economy continues to grow at the same pace as it's doing right now, the unemployment rate will stay relatively stable. You saw in the summary of economic projections, the Fed shows a very modest further increase in the unemployment rate from 4.2 today to 4.4%, but nothing beyond that. So it's sort of a soft, if you look at their forecast, it's a soft landing kind of story, and I hope they can pull it off.
Right now, the stock market and the bond market are trying to understand what the reaction function of the Federal Reserve actually is and to which data they're going to look at. It seemed like there was a renewed focus on both jobs revisions as well as the beige book, which was the input to potentially some of the heavier weight on 50 basis points. Do you view that now as sort of these data points as taking on outsized importance?
I think they are more focused on the labor market because there has been deterioration in the labor market. I think they're much more confident that inflation is going to continue to come down because they've seen, more slack in the economy and the labor market. They've seen, deflation progress that we've already had. They've seen wage inflation moderating. So I think their concerns are very much on the labor market side. So when I'm looking at the economic data right now, I'm really focused on the labor market data, and that will determine whether we just continue at a relatively modest pace after this of 25 basis points reductions, which is essentially what was implied in the summary of economic projections, or whether they'll become more concerned about downside risk, and then we'll have to throw in a few 50s.
Bill, congratulations both on what you said they should do and what you said they would do. And part of your argument was on the unemployment rate. So I want to go back to that. The revision up to 4.4% by the end of this year stays at 4.4% at the end of 2025. Are you comfortable that we can stabilize here without the tipping points that you were so worried about?
Well, we're going to find out over the next year. I mean, the sovereign rule is a very simple, tells a very simple story. When the unemployment rises beyond a certain threshold, the next stop is a full-blown recession. The question is, what's the right threshold? Historically, the sovereign rule threshold has been a 0.5 point rise in the unemployment rate on a 3-month moving average basis over a 12-month period, and we've already pierced that threshold. So you have to believe that there is some risk here. Paul was asked about the risk and downside risk to the labor market, and he sort of mostly dismissed that. But I do think that I actually do think the risks are maybe at best they're balanced, but I would actually be more concerned about the downside risk to the labor market now than the upside risk to inflation.
Bill, you'll always find a politician that's unhappy. I've found one. Senator Warren. This cut in interest rates is yet another acknowledgement that Powell waited too long to reduce interest rates. I do think the politics are relevant here. November 7th will be the next meeting. We might have a decision in hand by the American public as to who they'd like the next president of the United States to be. We might know the makeup of Congress as well. We might have a better idea of what policy looks like in 2025. Bill, you've lived this. You were on the FOMC back in 2016, I believe. Can you walk me through your experience back then and whether the same applies this time around?
I would be very surprised if the election outcome affected what the Fed does over the near term, because, an election outcome is one thing, but what the incoming president will be able to do with, a closely divided Congress remains very uncertain. And so I think the Fed reacts to the world as it is, as opposed to speculates about how the world could be. So I would be very surprised if the Fed doesn't cut rates at the November meeting. I mean, if they don't cut rates at the November meeting, it's because the economy is bounce back and very strong, or the inflation news is really bad between now and then, and that's not something I expect at this point. I don't think that Powell expects it. I think the odds of a 25 basis point rate cut in November are very, very high, and if the economy shows more weakness, then maybe even 50 basis points.
Hey, Bill, appreciate it as always. Bill Dudley of Bloomberg Opinion. The Fed should go big now. I think it will. It did. It did about an hour and 30 minutes ago. Let's bring in Michael McKee. He was in the news conference. Mike McKee, I want your thoughts on that press conference, where there was a little bit of tension for you. How did you walk out of this one?
Well, I don't think there was a huge amount of tension, except for the fact that, as you were just talking about with Bill Dudley, the idea that there is probably more risk to the Labor Department, to the labor market, than the Fed is letting on. And that's the concern. And to get to my question that Lisa mentioned, the Fed was data dependent until they were confident that inflation was going to be down to target. But how can they be data dependent on the unemployment rate? We don't know what it's going to be. And as Bill suggested, it could go up rapidly. Do we get a rapid response then, especially since policy works with a lag? It's a little unclear what their reaction function is going to be going forward.
Mike, looking forward to catching up with you tomorrow. Lots to talk about. Plenty more data just in the next week or so. Equities right now on the S&P, Lisa, firmer by 0.4%. The outperformance on the small caps, as you might expect.
Yeah, and the Fed basically gave this market what it was looking for, and then some. A question now of just how much this market has moved ahead of what the Fed has said. Mohammed, I would love your thoughts on what the new data dependency actually is, given the fact that people are looking for a litmus test to understand what the reaction function is of a Fed that kind of is playing with what they get, which is the same lack of clarity that we have.
Yeah, I think the data dependence all comes down to the labor market, and he went through in detail a number of indicators he looks at. And when he says the totality of the data, I think he really means it when it comes to the labor market. Lisa, I'm surprised you haven't picked up on the fixed income market and what has happened to treasuries, that they're now higher on the day. There's been quite a move. When the statement was announced, the 10-year went down to 364. It's currently trading at 370.
It's up 6 basis points.
It's up 6 basis points.
What do you think that is?
I think that there is some, and the curve has steepened. 2 stands are now 9 basis points. I think there is some concern as what does it mean longer term for inflation? That's the only thing I can think of. But the action has been really interesting. And once again, you end up in a different place after the press conference than you were after the statement.
Yes. No question about that. I think of David Kelly at J.P. Morgan. You know, John, he's been very good about a vector of non-farm payrolls that gets you to a negative statistic. 3-month moving average, about 116,000. Nobody's modeling in here if this job economy, as Anna Wong talks about, continues to deteriorate.
So what are we saying here, Mohammed? We're willing to accept 3, the high 2s, or we're worried about going back to 3.5, pushing 4? What's the story here?
So we cannot answer that story without bringing in fiscal policy, without bringing in structural reforms. I mean, that's the trap we have all fallen into, that we still think of the Fed as the only game in town, but there's other things happening that speak to what is that rate, and that's why the range is so wide.
You brought this up, actually, when Jay Powell said this. Over time, and we're going to get down to 2% over time. It raises this question, especially as he talks about not mission accomplished, but sort of, you know, wish and washed, but this idea that maybe we could end up with some
I'm not going to ask you to say that again.
Please don't ever do that again.
I won't.
No, but this idea that, you know, he's so excited about the idea of a soft landing that it will it's okay for it to take a number of years to get back to that 2% target.
And that's in the projections. I mean, I have him in front of me. He said core PCE right now is 2.7. They're projected at 2.6 at the end of this year, 2.2 at the end of next year, and 2 by 2026. We basically pushed back the target.
I like what you said about mission accomplished, and it's this terror of getting this wrong, whether you're a governor, a president, whether you're the chairman. Jason Furman out teaching Act 10 up at Harvard, and he was lectured by his daughter, John. We got a tweet out from Jason Furman where his daughter walked in and said to Professor Furman, "You were wrong." There's a lot of that going on right now.
A lot of people were wrong. I think we should point this out. The market was priced for something closer to 50 than 25. The overwhelming majority of economists in our survey, and we surveyed more than 100, not even 10% of them saw 50. So shout out Mike Ferroli over at JP Morgan, one of the very few, together with Anna Wong, I believe, over at Bloomberg Economics, who were looking for that 50 today.
Yeah, Deutsche Bank actually did an informal survey also that they put out today, and something like 61%, roughly, plus or minus 0.5%, came out saying that it was 25 basis points. So this really was kind of on the back foot.
I kept it quiet. Nobody cares what I think, but the fact is I was wrong.
Jeff Rosenberg of BlackRock joins us now for more. He wasn't wrong. He's been waiting patiently to give us his views on this. Jeff, let's talk about the bond market, and you can throw in your thoughts on this Federal Reserve decision, the projections in the news conference as well. The bond market's selling off. The 30-year's up 7 basis points. The 10-year is up 6. What do you think that signals, Jeff?
Yeah, I think the important point here is that there's the action and the 50 basis points, and then there's the expectation and what was priced in. And so while the bond market was leaning towards the 50 basis points, it was really more about that segment, Jonathan, of the press conference that you highlighted. I had it written in my notes as well. The interchange where Powell said, you know, don't take that 50 basis points as the new, you know, pace. And he pushed back against, you know, this is going to be followed by, you got several questions on more 50s. The problem, and I think to answer a bit of Mohammed's question, your question to Mohammed in that interchange, is that the bond market was pricing in more subsequent 50s, and into 2025 still is pricing in bigger increases than what you're getting in the S&P. And Powell in the press conference really pushed back against that. So I think you have two things going on. I'm very amenable to Mohammed and Lisa's comments that, you know, maybe this is a little bit of a sign of inflation and some of those concerns, what you're seeing in gold. But it's also, I think, in the immediacy, this is a little bit disappointing relative to what's been built up in bond expectations. And that, from a broader perspective, is really an important point from an investment perspective that you can have. Here's the headline. Fed cuts interest rates by 50 basis points, and the bond market returns are going to be negative today. So it's not just, you know, the action. I can anticipate, you know, the Fed's cutting rates. It's time to back up the truck in terms of duration. The problem is it's also a lot in the price. So they've got to over-deliver, and they didn't do that relative to bond expectations. And that's why I think you're seeing a little bit of that disappointment out of fixed income markets and their read on today's decision.
Jeff, Mohammed schooled me because, frankly, I wasn't paying enough attention to the bond market. The bond market is speaking, and the 10-year note is speaking. And what it's saying is it at least has a higher yield. But we are speaking to the bond market right now. Jeff Rosenberg, what is your reaction function? Does this make you less interested on the margins in buying 10-year or 20-year or 30-year treasuries?
Yeah, you know, I've said in lots of different contexts with you guys that you have to just be careful about where you want to own your fixed income, that the yield curve move can be more important, more determinant to your fixed income returns than just the direction of interest rates. A lot of times we just think about you want to own bonds when rates are going down, when the Fed's cutting. You don't want to own bonds when they're hiking. But because the curve is so flat, we're off the peak of inversions, but it's still a historic lack of premium in that back end of the curve, that where you hold your duration is going to matter as much as how much duration you hold. So it's still that story for me. It's still the front end is a little bit better 5 years in. You want to be careful about that term premium. And the other thing that I'm highlighting here today is you just got to be careful about how much is already priced in. This is unique about the beginning of a Fed cutting cycle. We're about twice the amount of expected cuts priced at the onset. This was John Otter's article in Bloomberg. He highlighted this. It's a great chart. About twice the amount of historic Fed pricing, about over 200 basis points, whereas historically you come in and there's only about 100 basis points. So a lot is expected. It raises the bar for subsequent fixed income performance. We've had a great run, but that tells you a lot of the performances in the rearview mirror. And so you got to be more thoughtful about where you own that duration around the curve when we look forward.
Does it give you more confidence, though, to go into risk, Jeff?
Well, you know, I think the Fed did its best, and that was the interchange you just had with Dudley. The press conference challenge was give 50 without spooking the market. I think they're successful today in there. That's the response in terms of small caps. You only buy small caps when the Fed's cutting rates, when you believe in the soft landing and the denominator effect. The discount rate is dominating, you know, any of your concerns in terms of growth. So I think they navigated that pretty well. I think when you go forward, you know, it is a soft landing baseline. I think that's exactly what the SEP is saying. When you look at all of the other economic data outside of the labor market data, you know, it's all very good. It's all very supportive for risky assets. And the fixed income side, that's a carry story. We're pretty comfortable with that. You got to be a little bit careful that it's asymmetric, that at very tight spreads, any sign of recession. And I don't think we're really seeing the recessionary signs out of the labor markets. But you have to be cognizant of it, that is the one place where you're seeing some weakness. But I think this is still support risky assets.
Just quickly, Jeff, November 7th, how different is that committee meeting going to be compared to this one?
Well, you know, as you pointed out, you know, you're coming on the backside of the election, but, you know, as Powell answered, they're going to try to avoid any kind of discussion on that. It's really going to be about the evolution of the data. You know, the interesting data point in terms of revisions, you know, we talk about data dependence. The problem is the data we're dependent on is not very dependable. All right, try that out slowly. But that's the payroll data, right? And so the revisions are going to be important. We're going to have another one. That's going to dictate a lot of the discussion. Without a deceleration, I don't think you're going to be talking about 50s, but they've clearly laid the groundwork here for a 25 in November, 25 in December. That's what I think will price back into the bond market. That's why you're seeing a little bit higher rates. If they deliver on that, then there won't be as much surprise or anticipation as we had in this meeting.
So, Jeff, let me ask the question that I suspect you hate being asked. And let's assume that you're being asked for a retail investor, 60-40, simple portfolio. What should they do now, given everything you just said?
Yeah, I mean, the part of this discussion around the 40, around the fixed income piece, Mohammed, is that it's not the old 60-40. It's not this era where bond volatility is 3%. Bond volatility is 6 to 8% in the post-COVID environment. So the 40 side is really where we've got to do some rethinking. And that's where we talk about diversifying your diversifiers, thinking about different ways of finding ballast in your portfolio because of the uncertainty of how duration and risk-free rates are going to perform in a more inflation uncertain environment. That's the points about the yield curve and what's already priced in. So I think in that 60-40, it's really about using different ways to find diversification and diversifying that 40 bucket away from kind of just piling into traditional duration.
Did I hear you say a more inflation uncertain environment?
That is what I said, yes.
I don't think that's what Powell thinks.
There's greater confidence that inflation is on a path to returning to 2%, but we're not at 2%. And that path, as we saw in the interchange, the shelter inflation, the uncertainty around how far we're going, and the wage inflation picture, right? There's a lot of confidence that we're moving towards there, but we're not quite there yet. That's the point about a more uncertain inflationary environment. And with respect to kind of negative stock bond correlation, which is really the driver of the 60-40 part. The challenge is that was really working well in your portfolio when inflation was missing from below. Inflation is still missing from above. And until you get back to the period where we have too little inflation, you're not really back to that halcyon days of fixed income and 60-40.
Jeff, this was perfect. Thank you, sir. Jeff Rosenberg there of BlackRock on the Federal Reserve decision. If you are just joining us, welcome to the program. It's a 50 basis point cut from the Federal Reserve with some dissent. The first dissent we've seen from a sitting governor on the FOMC going all the way back to 2005. Governor Mickey Bowman, not a surprise for many of you who's followed some of those speeches over the last month or so. If you're looking at the equity market, just about attempted to hold on to an 8th day of gains on the S&P 500, and it's a struggle. We turned slightly negative on the S&P. On the NASDAQ 100, we're negative by 0.05%. Mohammed, just a final thought. What I heard from you then, if you have any confidence the inflation story is done, that we're on a one-way trip now back to neutral, which might be around 3%, are you suggesting that confidence might be misplaced?
I think it's too early to declare mission accomplished. We've come a long way, but there are inherent contradictions that still have to be sorted. John, this was historic. I mean, we're going to look back on this day, not only as the beginning of the cutting cycle, but as having recalibrated what we mean by 50 basis point start to a cutting cycle. And we're going to look back, and either this will be the absolutely right bet, which is be preemptive on the labor market after you are reactive to inflation. This is a fundamental change in the reaction function. Or alternatively, we will look at this as being too aggressive. I'm hoping that it will be the first, because we all want the labor market to do well.
Of course, Michael McKee asked him about being preemptive, and he said data dependency or the totality of data. My big issue coming out of this is, do we understand the Fed's reaction function more, or do we understand it less than we did before?
I think we've got a lot of questions that still demand answers, and hopefully we'll get them over the next few weeks, but I doubt it. Once that data starts to come in, I'm looking forward to hearing from the rest of the committee, aren't you?
Oh, yeah.
Over the next few days.
It's quiet dissents.
Yeah. Let's just see how close some of them were to actually going 25 and not the 50. Mohammed, thank you. Just awesome. Thank you, sir. Appreciate your time. A pleasure, as always. Coming up on the close, a question: can we hold on to these gains? Look out for the team in just a moment. From New York City this afternoon, good afternoon. Thank you for choosing Bloomberg TV.
It's 3:46 on Wall Street. We do check markets all day long here at Bloomberg. The Fed goes big. Stocks move lower as of now. 14 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ all bouncing around, but right now losses for the U.S. stock market. 10-year 3.70% with a 2-year 3.61%. Stocks fluctuated as Jay Powell said the Fed is not in a rush to ease after cutting rates by half a point. S&P right now down 6, a drop of 0.1%. Dow lower by 80, a decline of 0.2%. We've got NASDAQ down 0.1%, down 21 points. Again, the 10-year, 3.70%. Gold down $19 the ounce, down 0.8%. West Texas Intermediate crude is now slumping by 1.6%. Today, big news with the Fed lowering its benchmark interest rate by 0.5 point, an aggressive start to a policy shift aimed at bolstering the U.S. labor market. Here's Fed Chair Jay Powell.
Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by 0.5 percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%.
Fed Chair Jay Powell in remarks carried live on Bloomberg Radio and television. So again, recapping, stocks bouncing around, 13 minutes to go ahead of the close. S&P right now down 11, a drop now of 0.2%. 10-year, 3.70%. For on-demand news 24 hours a day, subscribe to Bloomberg News now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody. Yes, indeed, this is Bloomberg Business Week. I'm Carol Masser. Tim is off for the rest of the week, and joining us, lucky for us, David Gora, of course, host of the Bloomberg Big Take podcast, as well as Bloomberg News correspondent. And I got to say, David, our head of radio asked me just before the Fed decision, so what do you think? And I said, 25 basis points. They don't need to do 50. Bam, I was surprised. You went with the safe guess. I did. The Fed going for 50, indicating, if you look at the median, there could be another 50 basis points here by the year end. And a lot of caution from the Fed chair during the course of his comments, not to sort of read these as kind of some sort of divine speak about what's going to happen here over these next few months, but certainly interesting and certainly interesting kind of commentary on where the economy is today and where he thinks and his colleagues think it's heading. A recalibration, yes. Right? We heard that a lot. And the markets have really kind of done a bit of a U-turn. We saw some rally in the equity markets. You heard Charlie breaking down the numbers, but we've really pulled off of that. And rates, which also moved a lot lower, we've seen them kind of level off some of those lows of the session. So let's get to it. Hey, I do want to point out over the next couple of hours, our next hour, actually, we're a shortened show. I'm still a little jet lag here. California, you're back. We're going to get a rate and market roundtable in just a moment. And then we've got a story about Stevie Cohen, among the most read stories on the Bloomberg. Deciding to step away from trading. He's done this before. Seems like maybe this time it might be for real or for a long time. And the point 72 saying this is for him to spend more time kind of mentoring staff and working on a larger strategy for the firm. But he is a guy who has a lot of irons in the fire. Chief among those irons, I think, the New York Mets baseball franchise. Yeah, he's a busy dude. Speaking of busy dudes, Elon Musk, we've got the authors of a new book, How Elon Musk Destroyed Twitter. All right, let's get to what you really want to hear about, and that is, of course, the Fed decision today. Fed Chair Jay Powell in his press conference after the decision, highlighting that labor conditions are pretty close to max employment and yet continue to cool, which has been a plus to inflation.
Overall, a broad set of indicators suggest that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures.
Bringing us now, Ira Jersey. He is the chief U.S. interest rate strategist at Bloomberg Intelligence. Brett Schutte is the chief investment officer at Northwestern Mutual Wealth with us as well. And Ira, let me start with you. Listen to you before this announcement was made today, kind of followed along on the Top Live blog as all of this unfolded. You were not one who was, shall we say, enthusiastic about this 25 or 50 betting game that was happening over the course of these last many days. What stood out to you, both from the statement that we got today and what Fed Chair Powell said there at the end? I was saying just a moment ago, he was quick to say that, this shouldn't read this as gospel, what the Fed intends to do here as the year goes on.
Well, that's always been the case with the dots, particularly since they've been changing them quite frequently at just about every single quarterly update that they do with that dot plot. But I think the near-term dots, when you think about November and December's meeting, they made it pretty clear that unless something significantly changes with the trends in the economy and inflation, that you're likely to see modest cuts going forward. So 25 basis points over the next couple of meetings. But I think that's less important to me. What I was focused focused on was what they said they were, where they said they were going to ultimately, and where they think they're going to, even with the economy not hitting into a recession, is all the way down to under 3% on the Fed funds rate. And the market was kind of bifurcated and remains bifurcated in thinking maybe the Fed's only going to cut to 4% or the Fed's going to cut to 2%. And the Fed decided just to take the middle ground of that and say, hey, well, what do you think about 2.5%? The way they get there, Fed funds rate at 3% and inflation at about 2%, you're talking about a 1%, median natural funds rate. And when you look at some of the models they use, that's just about where they where those are saying the neutral policy rate should be.
I got to just follow, Ira. It felt like a little bit of a surprise, at least for me. I know the debate that was going on, it was kind of, we just couldn't talk about it enough. But it did, when I saw the 50 basis points, I kind of yelled out in the newsroom, like, oh my God, like, is there something coming undone? Financial market conditions I thought were pretty okay. Like, economy still growing, corporate profits maybe not as upbeat. Like, is something wrong that we're missing, or what was the thinking behind the Fed?
No, and there was actually a question in the press conference to Chair Powell just about that. If they had the August payroll report, would they have cut in July at the July meeting? And he said he didn't know, but maybe, right? So, and that's kind of how I'm taking this 50 basis point move. It's more, hey, we probably should have gone in July. We want to go slow. So let's do 50 now to kind of catch up to where we think we're going to have to be. But importantly, and as you guys mentioned, as Dave just mentioned, before what I said yesterday was, look, I don't care about 25 or 50. What I care about is what does he say after that. And he said exactly what I thought he would say if they went 50, and that said, hey, we went 50, don't expect more 50s anytime soon.
Brett, let me ask you just about, you've been so good about saying that you see warning signs, there have been things that are making you nervous about the state of this economy. This was a confident Fed chair speaking today about the balance of risks, about the jobs market, feeling like this is the moment. They aren't behind the curve. He was emphatic about that. Didn't want this to indicate that they felt like they maybe missed something back in July. Has today's decision caused you to reevaluate or see in a new way any of those things that were giving you pause or concern in the run-up to today's meeting?
He has to be concerned about the labor market. I remind you that at Jackson Hole, he said, and drew the line in the sand, we neither seek nor welcome any further deterioration in the labor market. And so why did they cut 50 basis points? They cut 50 basis points because the labor market has been weakening, except for non-farm payrolls, which they continued to point to as the one shining light in the employment picture. That was had cold water thrown on it with the 818,000 downturn, and now you're at less than 100,000, or right about 100,000, which is in the margin of error on non-farm payrolls, while the rule they created back in the day, the SOM rule, has been broken. And so to me, this is the Fed clearly worried about the labor market and worried that they may be too late to actually cutting, and that's why they decided to take 50, not 25. And that still remains to be seen whether it's too late or not. Look, I just don't think that the Fed is going to land this perfectly, and that's where I'm a bit fearful in the market because it is priced more so that they will.
Yeah, I just asked a gymnast. It's not easy to kind of hit a perfect landing. Brett, let me just follow though. The equity markets, we saw quite a rally initially after that 50 basis points. I get that, but we've really pulled back on that. What does it mean for the financial markets, the equity play in particular?
Well, I think it was probably a bit of buy the rumor, sell the news. If you think about it, we had those leaks or those perceived leaks on Thursday and Friday of last week, and then maybe even Monday of this week. And so I think it was a little bit priced in already. Look, to me, I think there's a regime change going on underneath the surface no matter what. And this is where we've been pointing to optionality in asset classes like small and mid cap, which I think were already priced as if there might be a recession. One way or the other, despite recession or no recession, soft landing, we thought interest rates would be lower because we thought the Fed would have to lower rates to either affect that soft landing, or if we had a recession, rates would go lower because the economy is looking like it's at a tipping point. And so to me, that's where small and mid caps, they started rallying versus large caps or even the Mag 7, July 11th, which is the day after we had a CPI report that was weak and a jobs report the week before where it was closing in on the SOM rule. And so that's where I think there's opportunities for investors who are willing to look past any near-term volatility. It's just in asset classes that people don't want to own right now. But we think those are the path forward for investors.
Ira, in the minute we have left here, what is your reaction to what we saw in markets over the course of the last hour? I was struck when Tom Keene asked Bob Michael of JP Morgan just about what he's watching for. He said kind of automatically credit spreads. That's where his eye was headed. How about for you? What stood out to you in terms of reaction over the course of that meeting and press conference?
Well, you know, as a rates strategist, I have to talk about the Treasury market and what's going on in rates. So, you know, the fact that we bear steepened a little bit, I think, suggests that the market was more or less prepared for a 50 basis point cut. But importantly, they're worried that maybe the Fed's making a policy mistake, at least a little bit, right? And I suspect that once the dust settles, we're basically going to have very little movement in the long end of the yield curve. But two-year yields are probably going to continue to drift lower as the Fed continues to cut interest rates. So you get that bull steepening we've been talking about.
Before we go, real quickly, guys, first to you, Brent, 10 seconds. What's your next focal point in terms of the markets?
I mean, I think it's all about inflation and the unemployment rate. Where do we go from here? And is the Fed too late? I don't think inflation is dead if the Fed actually does go too aggressive. You're still late in an economic cycle, and the unemployment rate is still low, even though they've wriggled a little bit more slack. And you're seeing wage pressures pop up still around, such as Boeing and Amazon raising wages in the past few weeks, or trying to. So I think that's still out there.
Ira, 10 seconds for you. Next focal point.
It's the same. It has to be the economy, right? All of the main things that we look at.
I feel like bottom line, we're still data dependent. I mean, does that ever change?
Meeting by meeting and data dependent. We have the same clarion every meeting.
Jay Powell, right? Very clear on that. So appreciate it. Ira Jersey of Bloomberg Intelligence, Brent Schutte, of course, over at Northwestern Mutual. All right, folks, we're counting you down to the close. Over to our TV colleagues. The closing bell starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Alex Steele, taking you through the closing bell with a global simulcast that starts right now. Carol Master joining us in the radio booth alongside David Gura, filling in today for Tim Stenovic. Welcome to our audiences across all of our Bloomberg platforms, including our partnership here on YouTube. And Carol, you talk about the market reaction to that Fed meeting, the market reaction to Jay Powell. Not quite what we expected.
No. First of all, I was surprised by the 50 basis points. Kind of shocked me. We saw such a significant, or decent, I should say, equity rally right off of that. And then we've seen stocks retrench. So I feel like investors are still trying to figure it out. Does 50 basis points, David, does it mean that there's some troubles ahead?
Yeah, and I just was struck by how emphatic Chair Jay Powell was during the course of that press conference, saying the Fed is not behind the curve here, saying things are different than they were back in July, saying this isn't a sign that they missed the ball back at that last meeting. Very forthright. Also, promoting a lot of clarity, a lot of caution going ahead to this next meeting, that, it's not divine, it's not gospel what's going to happen next when they meet again in November.
But I am interested into the reaction function, right? It's very clear that they have zero tolerance for a weaker labor market. So what does that actually mean? So you get 1/10 of a tick up in the unemployment rate. What is that then reaction function? They're expecting 4.4% for U3 in 2024. So how do you then trade something like that?
And particularly, too, when we talk about this idea of that neutral rate coming up, at least their projection for it at 3.4%, definitely higher than what the market had priced in. So maybe you get a bit of a repricing. But as we always have to point out here, the market reactions that you typically get on the day of these Fed meetings can change in a big way in the days that follow. Here on this Wednesday afternoon, Fed Day, the screen looking a lot different than what it looked like just a few minutes ago. All red across the screen with the Dow Jones Industrial Average down roughly about 100 points on the day, or about 0.2%. The S&P 500 down about 16 points, or 0.3%. A similar percentage drop for the NASDAQ Composite, as well as the NASDAQ 100. And if you're looking for outperformance, well, there you have it on your screen, and it is minor outperformance. The Russell 2000 fractionally higher here on the day. We'll just call it unchanged. S&P mid-caps also similar move, and the Dow Transports a little bit better of a performance, though that's only up 0.4%.
Right, small caps at their highs today, up almost 2.5%. In terms of the S&P 500, though, if you look at it, almost an even split. More than 200 names actually gaining ground here at the close. 286 to the downside. So, Alex, a little bit more of a negative tilt.
Yeah, and you take a look at the IMAP. It is mixed, but I think that what it's mixed by is quite interesting. You have Well, actually, it's not that mixed. I was looking at mid caps. You're actually looking at the majority in the red. Utilities, though, not doing as great, and that's so interesting because if you were going to have a 50 basis point cut, you would have thought that utilities would have done really well, but that necessarily isn't the case today, which just shows that we can't really predict how the market's going to react to this. You have tech getting hit as well as financials.
Not a brat, Matt. That's a math, not on this Fed Wednesday. All right, let's get to some of the individual gainers, folks.
You're so hip, Carol.
She was just in LA. Was it LA? Where was she? She was somewhere
I don't know.
cool.
She never tells us where
she was somewhere cool.
She just disappears
there we
in the
go.
high seas for days.
Highly recommend doing a show on the beach.
Yeah.
It's a
thank
really
you.
good thing.
Thanks for rubbing
We'll
it
work
in.
on that.
Back on that, yeah.
You're all invited next time. All right, let's get to some of the individual gainers. GM finishing off its highs, at its highs up more than 4%, but still a 2.4% gain here at the close. A top gainer in the S&P 500. The company's EV customers can now tap into the Tesla I superchargers starting this month. Remember they had an agreement last year between Mary Barra and Elon Musk. So some upward sentiment, if you will, for General Motors. Victoria's Secret, check it out, guys, up about 3.5% here. The company was upgraded. The stock was to equal weight from underweight over at Barclays, which said the worst is behind the company. Also raised the price target to $25 a share from $23. So the stock finishing pretty much at $25 a share in today's session. HubSpot, another one, an outperformer, up 2.3%. Call options also tripling today. Our BI team out with a note talking about the company's analyst day, saying the company's position in sales, marketing, and service software continue to strengthen in the small and medium-sized business segment due to AI innovation and more. And they also noted some of the company's product launches. So that's some of the outperformers here today, David.
Looking at those underperformers today, a few caught my eye. Zegna Group, maker of men's suits, men's clothing, Italian company, went public via SPAC back in 2021.
I think Romain, your suit came from there.
I didn't want to call him out. Perhaps it did.
He has a whole wardrobe here. That's the thing.
Anyway, flagging that profits were lower there at that company in the first half of this year compared to the quarter and half before
so
that.
I can expect some discounts?
There you maybe
Now you're talking my language.
Check it out. Anyway, kind of emblematic of the fact that luxury is going through some difficult times here. The CEO saying today that it's going through an important normalization phase given macroeconomic and geopolitical uncertainties, and the overall environment is expected to remain even more challenging in the weeks and months ahead. Another company suffering a little bit today is Cisco, food distribution company. The CEO of that company speaking at a Wells Fargo consumer conference in California today, saying the traffic is down at restaurants by as much as 3 or 4% and sees that being a persistent problem going forward here. That company closing lower. And then Trump Media and Technology Group. We are at this pivotal moment. Of course, Donald Trump owns more than half of that company's stock, more than $1.8 billion worth of it. The lockup period by which he can't sell that stock ends tomorrow, provided those shares don't close lower than $12. He says he's not selling. We'll see, but the company continues that kind of downward slide we've seen since March when this company was trading above $60 a share, far below that today.
So that's sort of the micro look. On a macro level, we go back to the bond market. We're looking at a sell-off all across the curve. You got the 2-year yield up 3 basis points. The 10-year yield is up 7 basis points. That's the most since August 15th. I know it doesn't seem like that long ago, but a lot has happened since then. But what's so interesting, if you look at an intraday chart of what the bond market did, particularly in the 2-year, you get a 50 basis point cut, you got buying right away, and the yield falls. And then as the conversation continues and the presser gets underway, and it seems like the Fed is in no rush, you guys, to do any more 50s. They're in no rush to cut dramatically and drastically, and then you wind up seeing the selling kind of pick up, particularly on the long end.
There's a big question that I have, though, and the question is, when we look at the targets that they have on the dot plot and what Jay Powell said today, how much can you really take that as gospel here? I thought Mike McKee, when he sort of broke the news at 2 p.m., he pointed out a couple of big things. This was the first dissent that you've had on the FOMC since 2022, and the first dissent by a Fed governor since 2005. And he seemed to suggest here that this might be an expansion of that type of dissension going forward over the next few meetings as everyone tries to figure out where we're going.
Which makes you think about the future discussions, right, around the dot plot as new data comes in. I was thinking about tomorrow at 8:30 a.m. Wall Street time, weekly jobless, like these weekly reports, which are much more timely data than the monthly jobs report, David, become even maybe more important.
We just have to keep thinking about the crucible in which this is happening. Of course, we have an election coming up. This was the last meeting before before that election. The next Fed meeting takes place a day after people go to the polls here in the U.S. This Fed chairman, emphatic as he has been before, growing increasingly irritated, I think, with this question that the Fed might be susceptible to political influence, saying that wasn't the case here. That's not going to be the case going forward. But we already have a statement from Vice President Harris applauding the Fed for the move that it made today. And then we have Donald Trump, the former president, here in New York tonight at a big rally in Nassau County. He's trying to get folks elected down ballot, House races in Hudson Valley and in Long Island. No doubt this is something he's going to bring up during the course of the speech that he gives tonight. So we'll be listening closely to what he has to say. He's kind of questioned the merits of the Fed's sort of very storied independence in past speeches.
Mention SALT and all of us in the New York metro area.
True.
It
Very
definitely
excited by
catches
that,
our
yes.
attention.
We start to pay attention again. It's 100% true. But if we go back to where we were last Thursday, so that was more of the 25 camp, right? And then you had the Wall Street Journal article come out on Thursday night where Nick Timrose talked about the fact that 50 might be on the table. Then you saw the market re-rate on Friday, and that continued. So in my mind, don't you just like kind of check out and check back in 4 days until the next Fed meeting and see what we're talking about? I mean, that's kind of what happened.
I think that is kind of what happened. It's kind of basically the Fed didn't meet the market, and the market was happy with that. And like I said, what happens over the next couple of days? But I thought, just to David's point too, about the political, I don't know, implications, if you will. I know Biden is supposed to speak on this tomorrow. You do wonder how this is going to sort of play into the election cycle as people now start to talk about inflation coming down. Maybe interest rates ends up being a net positive for some people's pocketbooks. I don't know if it's going to come that fast, but that'll surely be the pitch that you might hear out of Harris and Biden. I don't know if you're going to hear that from Trump because, you know, why?
Well, all I would say off of that is watch the housing market, watch the mortgage market, right? If people start to buy houses, that's certainly some economic activity. That would be a new trend that we haven't seen in some while if we start to see
I have a dream of buying a house one day.
It'll happen. It'll happen.
Well, if you stop buying new suits, you might
Right,
be able
there we go.
to
It all comes full
afford-
circle.
No, but he needs the brownstone for the suits. Guys, it all works together.
Yes.
It does, it does, it does. All right, great wrap up, you guys, on this Fed Day. That's our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals, we do it all. Those guys continuing, certainly on the TV side of things, and David and I are going to continue here on Bloomberg Business Week on Bloomberg Radio. We'll see you again, same time, same place tomorrow.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
All right, we're done with Fed for a while.
Okay.
Until
Fair enough.
November 7th, in the lead up till
fewer
that.
months, yeah.
All right, this story definitely catching our attention. It's a Bloomberg exclusive, a most read story on the Bloomberg about the billionaire hedge funder, one of the best known names, I would say, in the hedge fund universe. Dominated, David, the industry for 3 decades. He's had some very public ups and downs, owns a major sports team, and has even been brought to life in a streaming series.
Yes, Steve Cohen, who currently runs Point72, announcing he's going to be stepping away from sort of day-to-day trading at the firm. And Kathy Burton has written about that for us here at Bloomberg. Kathy joins us now in the Interactive Brokers studio. Kathy, great to see you.
Nice to see you.
What prompted this move? I mean, I was saying to Carol earlier, he's done this before. He's threatened to do this. He's walked away from day-to-day trading before. Why now? And is this time, do you think, different than in the past?
It's really hard to say because he has done it before. He said, okay, I'm not going to trade anymore, but he is very much an animal of the markets and always has been. And so it's possible that if things get really crazy around the election, he could step in again. But I think really the idea is that he thinks that he does more good mentoring people, working with other traders than doing his own book, especially because the firm is so big now.
Does the investors agree with that?
Yes, because I think over
the next
time,
generation?
he's been cutting back.
Okay.
Like even a year ago, this time of year, he apparently was trading less than he had before. So, and people are pretty happy with the performance. And so they think it's big enough now, there's enough teams. It's not like just old school SAC when he was running the show.
For those who don't know, how big a firm is this, and sort of how much is it him? How much is it Steve Cohen's firm? How much influence does he have? I know it's a co-CIO position. What's the relationship like with the other CIO, and sort of how much has he been running it and calling the shots?
Well, I think if you go back to when it was SAC, he was calling a lot of the shots. It was his firm. But now I think he really does it. Like his portfolio would have been a tiny percentage of the $35 billion that they run.
I was going to ask how big the book is. I mean, is it a big
Yeah.
relatively speaking, I suppose.
So if he's doing, $1 billion or something, that's still not that much percentage-wise of $35 billion firm. And I doubt it was even that large, but.
One of the things I love about your reporting is that you remind us of kind of who he was, and even as a kid. I mean, he does really love to trade, which kind of goes from how we started, that, you do wonder if he'll be drawn back into it. Remind us kind of about who he was even as a young kid and his kind of love of the stock market.
Yeah, well, we were told when we wrote a profile of him back in the day that when he was at Wharton, he would actually leave class and go and just watch the tape.
He'd skip class to do it.
Yeah, and he just got a feeling of how stocks would move.
There was this period when there was a settlement with the SEC. He stepped back. He wasn't managing money for
Not so
2
great.
years. No. What was that like? What do we know of what that was like for him? And sort of, I mean, you hit on this in the story. It is a remarkable renaissance here to go from that, and he was never himself charged with anything or tried, but to have that kind of rebirth, how astonishing is that, and how did he manage it to do that?
It is astonishing. Yeah. I mean, I think it helped that even when he opened the doors again, he's had $10 billion, which is a pretty big amount of money. It was all his.
Yeah.
And then over time just started to replace it. It took him a while. I think initially it was more individual wealthy people, and then became more institutional even over time. As more time passed, he got bigger clients. And that's how he got to $35 billion.
He's been such a dominant force in the industry, but he's not necessarily somebody, right, that goes on camera a lot. He's very quiet, right?
Yes, yeah. He's not someone like Bill Ackman who goes and is tweeting every day. And I mean, the only first time he went on social media was after he bought the Mets.
Right.
And it was all about baseball.
Well, what does it mean kind of about, you say he's 68 years old, like I do think about, he did buy the Mets, right? Like where he is in his world, that maybe this time of stepping back is something more official because he's thinking about, I don't know, you do get to a point where you get older, you're thinking about, okay, what's left? As one guest once said to me, you start to count, how many more summers do I have left? And I do wonder, you're much more familiar with him than most of us, like what he might be thinking.
Well,
or am I thinking too much about this?
I do think that he's still very, very involved in the business. I mean, I think the co-CIO thing is for real. It's just this maybe the minutia of the markets. That's the thing that he's stepping away from. Yeah. And like I said, even people who know him very well say he said this before.
He's such a well-known name and figure, and there's a line in the piece that jumped out to me. You said this move is a litmus test to determine whether multi-strategy firms can thrive beyond their legendary founders. You invoked Bill Ackman a moment ago. I mean, there's a handful of people like this, well-known hedge fund managers. Talk a bit more about kind of the overall symbolism or importance of this for the industry. Again, there is this group who have been in the business now for many decades. I'm curious, sort of, is there much in common among all of them as they think about what the future might be? As we've seen some step back, how's that gone in the past? And how difficult is it to move away from being such a name brand, is a crass way of putting it, but being so associated with a particular firm?
I think that actually for Point 72, it would be easier if Steve went away completely, which, as I said, is not, he's still super involved. But I kind of somehow see that at that firm, it might be easier than at a place like Citadel, where Ken is such a big part of that firm.
Really?
Yeah.
Because I always think he's just so, Cohen is so identified, right, with the success of his firm.
No, but because I think the whole experience that happened of restarting again and becoming much more institutionalized, and that was only 10-ish years ago, right?
So, I want to ask you if you could sit down with Cohen right now, or maybe you did. You don't have to reveal. Like, what is top of mind for you about kind of what you would want to know from him?
I would like to know whether... I kind of doubt that he's going to stay away from trading. So I would like to ask him what would bring him back.
Yeah.
And if he, the whole idea of buying the Mets and being super involved in the Mets and caring about that, if he could imagine a day when he would just leave the business and focus on other things like baseball.
which I would like to do as well. But
fair enough.
You having covered SAC and Point 72, I think a lot of the criticism and indeed like scrutiny of SAC was about the culture of that firm. How different are the two cultures of these places? So in that reinvention, yes, it was kind of building it from the ground up if the ground is $10 billion, but how different are the cultures of the first shop and this one? How has he kind of changed the way that this one operates versus that one?
Well, Steve was definitely much more involved in the first one, in trading. He sat in the middle of the trading room and talk on the microphone all day. And he was very close to all the people. I remember someone telling me a story of one guy who worked there for years coming home, and Steve was on his couch, like watching golf.
Oh my God. Are you serious? How does that happen?
So he was like, this is really, really back in the day when it was a small firm.
What?
Carol can't get past it. I don't want our bosses to get any ideas.
There's
either.
a book here about the inner working.
And now I think it's a place where there's so many more people.
Yeah.
Yeah.
And I mean, they were really a band because when he left Gruntel and started his own firm, it was a handful of people.
I said that, he was the inspiration for, I don't know if there was the inspiration, but certainly anybody who watched Billions, right? Yes. We were like, it's Steve Cohen, just got 30 seconds left here. I mean, watching that, do you think they got a few things right in a big way about Steve Cohen?
No, I think that...
Did he watch it? Do you know, since you do have conversations with Steve Cohen?
I stopped watching it a few seasons ago.
Did Steve Cohen watch it?
Oh, did he watch it? I don't know. He must have looked at it. Or some people who know him must have looked at it.
Yeah.
But that's really more of an amalgamation of so many stories from the hedge fund industry.
I know, we just like to make that jump, the inspiration. Kathy Burton, thank you so much. Bloomberg News hedge fund reporter Kathy Burton, as we said, an exclusive and among the most read on the Bloomberg. And maybe he'll come back, maybe he won't. Maybe we'll have another story like this in a year.
Magnetism of the computer draws him back.
Oh my God. Coming up, the social media platform that changed so much, the well-known individual that changed it so much. Up next, how Elon Musk destroyed Twitter. This is Bloomberg.
It's 4:21 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ all ended the session in the red today. A rally that briefly drove stocks to records bumped into a wall as the Federal Reserve signaled it is not in a rush to ease policy after cutting rates by half a point. S&P fell 16, ending the session at 56.18, down 0.3%. Dow Industrials down 103, a drop today of 0.2%. NASDAQ down 54, a decline of 0.3%. 10-year on this Fed Wednesday, 3.70%. The 2-year, 3.61%. Gold down 0.4%, 25.60 the ounce. And West Texas Intermediate crude down 1.4%, 70.18 a barrel. So is Fed Chair Jay Powell ready to declare victory on inflation? That question today at the news conference carried live on Bloomberg Radio.
The goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Fed Chair Jay Powell. Again, the 10-year, 3.70%, the 2-year, 3.61%. Recapping stocks lower, S&P down 0.3%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Yeah, we definitely follow him a lot. And I got to say, a day doesn't seem to go by, it seems, without some sort of headline that is about Elon Musk or something in his world or a tweet, David. Safe to say that. And that includes, of course, what happens on Twitter, now X, which he bought back in 2022.
Back in 2020, it feels like, this has been an odyssey going through all of this, and our two guests know that very well. Kate Conger, who's a technology reporter for the New York Times, Ryan Mack, also with the Times, and their new book is called Character Limit, How Elon Musk Destroyed Twitter. And you've chronicled this so well, and Kate, let me start with you. There's this line in the book, kind of a nod to T.S. Eliot. It may end with a bang or a whimper or an improbable success, but what is clear is that Musk has destroyed the platform. Going back to the beginning, this was a guy who loved it, clearly loved Twitter, maybe had some dreams of improving the thing. Was it always preordained that this was going to be a mess, or was there any glimmer of hope from the outset that this could kind of fundamentally change for the better, this social media platform?
I think there was a lot of fear about Musk coming in and how things were going to go under his leadership. But I think there were a lot of people who did have that hope. Even some employees at Twitter thought, okay, maybe he's going to be able to do for us what he's done for SpaceX and Tesla. And, what we really wanted to show in the book is that Twitter was mismanaged under the previous management. It was not a well-run company, and there were a lot of problems going on. And so I think a lot of employees saw that and thought, okay, maybe we're finally going to cut through some of this red tape that's prevented us from doing the things that we need to be doing. And then, obviously it was got pretty messy from there.
And then the story goes different. Ryan, come on in, because I do wonder, Elon is written about, talked about so much. We've got a podcast here at Bloomberg devoted to it. We have a bingo card when it comes to earnings. Walter Isaacson just wrote a big book, an authorized biography of him. So when you guys thought about how you wanted to approach it, how did you do it on someone that is so talked about and so written?
Well, I want to know what's on that bingo card first.
You can find it online.
Yeah. Well, we embarked on this book. We were both reporters at the Times, and we had done almost daily stories on this takeover. And we were still finding that we couldn't get all of our reporting into these stories. Just insane details. One day we heard, he cut janitorial services. There was no more toilet paper in the bathroom. Like, one day he wasn't paying rent. And we just felt like there had to be a bigger kind of place to put these anecdotes and these pieces together. The Isaacson book was good for Elon's perspective and telling his side of the story.
And he cooperated.
And he cooperated for, I think, 2 years. And we use that as a resource. It's good to have that and see that and see what Elon wants to have out there, essentially. This part of the book is for the other side, for the employees, for the executives that he might have screwed over. That kind of perspective. We talked to more than 100 people for this book. And I think we did it justice. So, yeah.
He's somebody who so clearly seems stretched thin. He has all of these businesses that he's either founded or got majority stakes and then taken over. And he would want me to say that, not say that. But I'm kind of curious of how involved he is in the day-to-day at this stage. So obviously I see him tweeting all the time. He's still doing that, but you mentioned cutting janitorial services. Does he have any kind of managerial apparatus around him? What is the kind of Elon Musk enterprise like? Either of you can take that, but
He really likes to keep it small. He really likes to be involved in the details, and there's so many moments that we came across in reporting the book where we were just kind of shocked, honestly, by the level of detail he wanted to be involved with things. I mean, there was a point where he's taking out or putting in an Oxford comma and something, and
some of the ad copy.
Yeah, and complaining about the comma use in the copy that's going to go in the App Store, and arguing over pixel placement on the screen, and the way the metrics, the retweets, the likes are going to look. He's so involved in every little detail, and so I think
is that a bad thing though necessarily? Like you think about some of the tech disruptors, innovators, right? That they're so involved in how something looks and how it's packaged and how it goes out.
At SpaceX and at Tesla, there's
and at
like
SpaceX, you're shooting people up into or missiles and rockets, and you want to make sure you get it right.
And he's hired this pretty robust ecosystem around him at those places. And what we've heard from people there is, he'll dip in. If there's a problem, he'll take care of it very intensely, and then he'll leave, and it kind of operates on its own. Twitter was not built that way. These were not his people. These were not people he trusted. In fact, he thought a lot of them were corrupt or inept, and that's why he started to cut. But he didn't have that system around him, so he kind of hyper-focused on this problem and kind of made it worse for him as he kind of got stuck in the details.
Kate, you brought this up a minute ago, and that is this is a company that had a lot of problems before he took over. Why was that the case? Like, if you look at it in complement with Facebook or other sites, why did it stall out? It seemed to stagnate and stall out in terms of advertiser money and growth. Is that strictly a managerial issue? What accounts for it? What left it in the kind of state it was in when he took it over?
I think there's a couple of things. I think one of the things that held Twitter back from sort of growing at a Facebook level rate is that Twitter always kind of tried to be more privacy protective for its users, more open to different types of speech. And, advertisers are skittish about that. They don't want to be placed alongside some of these famous harassment campaigns that Twitter had back in the day.
It's gotten much better.
It's, it's always a struggle.
I mean, Twitter famously allows porn.
Right. They allow adult content, and they also wanted to protect user privacy, and so they did a lot less ad targeting than Facebook did, and so advertisers didn't find it as valuable. But I think over time, we also saw Jack Dorsey, one of the co-founders and the CEO for a long time, become really disillusioned with the business side altogether and just kind of throw up his hands and walk away from it a little bit. And so, I think the company suffered at that point from neglect, and it got into a position where it was ripe for a takeover like this.
What was going on, Kate, behind the scenes when, of course, Elon came out, like he was secretly buying shares, made the offer, and then was very quick about well, maybe I'm not so interested, right? And then there was legal action, and eventually Twitter was kind of basically forced the deal. Did they have to at that point? And you talk about the business was not great anyway, right? Did they kind of almost have no choice? What was going on behind the scenes? Why they forced it?
Yeah, so when Elon first came into the stock, there was this big effort among the executives and the board to sort of bring him into the fold, get him a seat on the board. And so he has this crazy meeting where he flew out to San Jose and they rented an Airbnb. And it's him and Parag Agrawal, the CEO at the time, and Brett Taylor.
There's donkeys around there.
Right, they're sitting down to this weird dinner in this Airbnb next to the airport. So they tried really hard to bring him into the fold. And that, it didn't work. He likes to be in total control. And then, it's this really heartbreaking decision, I think, that certainly the board struggled with and a lot of the executives struggled with, of needing to sell, being sort of forced to sell. They had to do right by their shareholders, but thinking, do we really have to sell to this guy?
Is there anybody? Where's the White Knight?
Yes.
Jack Dorsey, where are you?
Well, Ryan, on that point, there has been so much of a sense that this could be this kind of utopian place, this town square, or a place where free speech would flourish. And there's this moment, I think, where like Jack Dorsey says, I don't know if it's to Elon Musk or it's just in the water, like this can't exist as a company. If it's going to, if you're going to realize that vision, it can't be this kind of standard for-profit company. Was that something into which Elon Musk ever bought, or like was there ever any notion that he was going to kind of like embrace this, some sort of new kind of entity?
They shared text messages about that, and I think Jack also talked about it becoming a protocol, something that isn't reliant on advertising, for example. But I don't know if it was something that Musk actually believed in or was just lip service. He also talked about building a crypto-based social network. This is one of his ideas before he actually bought Twitter. He was talking about it with Kimball Musk, his brother. But he switches on and off ideas all the time. I think that's a common theme throughout the book, where he's kind of flying by the seat of his pants. And one day he believes in something, the next day he doesn't, and then he's back on. So that's a common theme that we see throughout. Yeah.
What was like kind of the most revealing as you guys went through this process? Because as we said, there was so much reported on it. What did you, Kate, some of the stories that also came out that you were surprised about?
Oh gosh, I mean, there's so many little things in this book that were surprising, and I think even
it's not that Elon has another child, because there's just a lot of children.
There's
we have a fun story on that one in the book. Yeah, we can talk about that.
That is there.
I mean, I think there's just, you think it's crazy, you sort of ambiently know that, and then you get into the details, and there's just so many little things that are just like, oh my God. And I think there was a point where Ryan and I were working on the book, and he was reporting the section on Twitter Blue, which was Musk's plan to sell verification checks.
I do kind of miss my check. I'm not going to pay for it, but I kind of miss it.
I do miss it too. But, he kept interrupting me over and over again and just being like, you're not going to believe this, you're not going to believe this. And I did it. I mean, it was just the craziest schemes that Musk and his cohort were coming up with of, comparing a verification checkmark to buying a luxury handbag, and that it was going to be this status symbol that people were willing to spend a lot of money on. And, I will open my wallet for fashion, but not so much for a checkmark. I was like, I don't think you understand.
No, I don't have one. I
I
haven't paid for it. I still have mine. He gave it back.
Ryan got his back.
You got yours back.
I don't know how.
That's a status symbol.
I also was suspended for a little bit. So.
Yeah, Ryan was kicked off. Now he's verified again.
You've lived it.
Yeah.
All the ups and downs.
Yeah.
I mean, we're going to continue. We're going to do a little bit of news, but Ryan, 30 seconds. I mean, do you feel like Elon has any regrets at having bought it at this point?
I think he said he's had regrets about paying that much, right?
Yeah.
He knows he overpaid, but at the end of the day, he got his favorite toy. This is like a billionaire buying a yacht or a soccer team. This is the thing he coveted the most, and he owns it now, and he's the most followed user. So.
Well, we're going to continue with this conversation because I am curious about what you guys think comes next at this point, because I don't think the Twitter story, right, is done at this point. It's a great business school case study, but it's still being written. We're going to continue with Kate Conger, technology reporter at the New York Times. So is Ryan Mack. Their new book that is out, Character Limit, How Elon Musk Destroyed Twitter.
Ryan has a tattoo of it on his arm.
Do you really?
Maybe
it may be temporary tattoo.
Yeah. More to come. This is Bloomberg.
4:40 on Wall Street. We do check markets all day long here at Bloomberg. The Dow, the S&P, NASDAQ all ended Fed Wednesday in the red. 10-year, 3.70%. The 2-year, 3.62%. S&P down 16, finishing the Wednesday session at 56.18, a drop today of 0.3%. The Dow down 103, lower by 0.2%. NASDAQ was down 54, a decline of 0.3%. Spot gold down $11.50 the ounce to $25.57, a decline of 0.5%. And West Texas Intermediate crude down 1.4%, $70.19 a barrel. A rally that briefly drove stocks to records bumped into a wall as the Federal Reserve signaled it is not in a rush to ease policy after cutting rates by a half point. Reaction to today's Fed decision from Brent Schutte, Chief Investment Officer at Northwestern Mutual Wealth Management, who was a guest on Bloomberg Business Week.
To me, this is the Fed clearly worried about the labor market and worried that they may be too late to actually cutting, and that's why they decided to take 50, not 25. And that still remains to be seen whether it's too late or not. Look, I just don't think that the economy, that the Fed is going to land this perfectly, and that's where I'm a bit fearful in the market because it is priced more so that they will.
Brent Schutte of Northwestern Mutual Wealth Management, interviewed right here on Bloomberg Business Week. Amazon raising the pay of its hourly warehouse workers by at least $1.50 an hour and tacking on Prime memberships to their benefit packages. Today we had shares of Amazon declining, down 0.2%. Recapping, a move lower for the S&P, down 0.3%, 10-year 3.70%, and the 2-year, as the Fed cuts by 50, 3.62%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Charlie, thanks very much. David Gura in for Tim Stanback with Carol Massar on Bloomberg Business Week on Bloomberg Radio, talking about Character Limit, how Elon Musk destroyed Twitter, a new book by Kate Conger and Ryan Mack, both tech reporters for the New York Times. Continuing our conversation with them. I mentioned earlier he had this real affection for Twitter. It's something that got him into trouble, financial trouble, many times before. I mean, I think really vividly he got into trouble with the SEC. He tweeted out earlier, before all of this happened, that he had the money to buy Twitter effectively, and there was supposed to be, as a result of that, this Twitter sitter, somebody who was there to kind of approve or vet the
a supposed lawyer,
a supposed lawyer.
Yeah.
That never happened. I guess why I ask is I'm wondering sort of like, has his use of the platform changed over the years? And I think back of kind of pivotal moments in the site's evolution, COVID chief among them, when I think a lot of people, handful of people, I should say, like changed their tack or their attitude on it. How did it change him? How did his use of Twitter change over the course of its existence?
So it was really interesting, actually. We went back through his Twitter archives and started reading his posts from the very beginning.
My God, how long did that take?
It took a while. No, it took a while.
Our brains are a little rotten at this time. So.
But it's remarkable how normal his early tweets are. I mean, he tweets things like, "Oh, I'm going to the ice rink with my kids," and like, getting a sandwich, going to SpaceX, like just really normal posts. And it was just jarring to go from what he posts now back to those sort of, much more tame days. But yeah, I mean, he's just really intensified his use of the platform over time. I think he's learned that he can use it to push back on narratives about him and kind of spar with the media, and to promote his businesses. He's talked about how he can just promote Tesla using his Twitter account. He doesn't need to pay for traditional advertising. And he's just gotten more enmeshed in the platform, I think, as time has gone on, where he gets all of his news and all of his information from X and from the kinds of accounts that he follows, which are often on the verge of conspiratorial.
When you say that, I think like something that stood out to me is how this used to be like his outlet to normalcy or reality. I don't know if I'm paraphrasing what you said in the piece, but this used to be like for a guy who is very wealthy and very busy and kind of closeted in this very tight security. It was a means of being a normal person or having access to normal people. That really seems to have changed.
Yeah.
What access to normal is, I guess, has changed.
Yeah, well, and I think setting aside a lot of the things that Elon is actually saying, I think one of the things I find so fascinating about him as a tech executive is that he has tried to stay like normal and relatable to people in a way that, you know, a Zuckerberg, for instance, is not. He's blanketed by layers and layers of PR and lawyers, and, you know, I don't think he's very often hopping, you know, onto his comments on Instagram and replying himself without running it by someone, you know. But Elon has always been very raw and very real on Twitter.
And gets away with a lot of it that no other publicly traded CEO would get away with.
We look at
It's
it this
staggering.
week. He's just joking. You know, a lot of when he says something, he goes too far. He's just joking. You know, and he has the ability to delete it and move on. And there's very little repercussion for him.
Right, and you mentioned the SEC situation earlier. I think the fine that he received in that case was $20 million, which for him, I mean, it's probably a sandwich. You know,
It's a parking ticket.
You know, you guys, the title of the book is How Elon Musk Destroyed Twitter. Ryan, I mean, do we know? I mean, is Twitter destroyed, or can it?
So
can it go through rehab and come out on the other side?
The subtitle's meant to be provocative. It's meant to generate a discussion. I think on the name alone, though, he's changed it from Twitter to X. So Twitter's gone. We still call it Twitter, but that's, I think, a reflex.
Or we say X, formerly known as Twitter.
Exactly.
Like, it's cumbersome. It's not comfortable yet.
The artist formerly known as Prince.
Correct. Correct.
You know, we also you look at it from a financial perspective. He bought it at $44 billion. He's now valuing it internally himself at $19 billion. Fidelity had marked it down to $12 billion.
Yeah.
I mean, that's a financial disaster. Like, that's not a good place to be, you know, as a businessman. So,
well, on that note, I wanted to ask you about the reputation he has as a good businessman. And I was like reading your book in compliment. I just read our colleagues Max Chapkin wrote a book about Peter Thiel, and kind of we get to revisit this era when he's it's like X versus Confinity, this kind of PayPal predecessor, and like he's really motivated by kind of peak and rivalry. What conclusions can we draw just about him as a businessman? Yes, we can kind of give him props for inventing this or that, or getting into electric vehicles or rocketry or whatever, but on the merits as a businessman, what did you come away from thinking?
I think if we're judging him by the merits of capitalism, he is one of the greatest of all time. We're talking about a man worth $250 billion. You know, he's grown two massive companies in SpaceX and Tesla. He's building more companies. But just because you're an expert in rocketry or vehicle development doesn't necessarily make you the best person to run a social media company. And I think that kind of hubris that he took into Twitter really hampered him and has affected him where he's not listening to other people. He thinks he's the best. He's the alpha. He's the person that should be listened to. And that has really hurt him as he's tried to take over this company.
Yeah, an active investor, right? I think about Kathy Wood early in on Elon Musk and certainly Tesla, but described him akin to Thomas Edison of like our time in terms of his ability to create and really change things. So Kate, I don't know, is there something Elon can do with Twitter X going forward? Or I don't know, how do you guys think about it as you report on him? You know, does he want this to be a success? Like, what does he want?
You know,
do we know?
He's always said that he doesn't care about the finances of this deal. He says, I don't care about making money. He just wants it as an ideological platform, basically.
Yeah.
And so I think he feels...
I want the old Twitter.
Right.
I want it so when news is
So
breaking,
nostalgic,
it's the place to go because
Yeah.
everybody jumps on. I mean, media, we've loved it, right? But it was such a cool place to go, and now it's not. So
Right. Well, and I think, you know, he's really made it into something that's very catered to his interests, especially now that he's more into politics, right? He's convinced Trump to come back onto the platform, which Trump was very resistant to for a long time.
Well,
you know,
he's got his own.
Right. He's had his own thing. And, you know, Musk has gotten Trump to do Twitter Spaces with him, to talk on the platform. He just did another one the other night about his crypto business. And so I think Musk views that as quite a success. And I think the more he uses it for political gain, and if he sees that come to fruition, I think that that'll be really rewarding for him.
Final thought from you, Ryan?
Yeah, I don't know where this goes, actually. You know, it's interesting to watch him like flail every day, I guess. You know, today he tweeted a fake bomb threat, essentially. And this is a man that has 200 million followers on the platform. You know, he controls it. So I don't know. Tomorrow, I don't know what it'll bring. So
test that relative impunity.
Exactly.
Yeah.
Bottom line, can we get your tattoo?
Of course, yeah, we'll get you guys some tattoos.
Tattoo
You
for the book.
got to put them somewhere visible, though.
Yes, we will.
As I go
On Twitter, you can tweet it. On X, sorry.
Are you going to do that, David?
Maybe.
Maybe. Congratulations,
Thank you
guys.
both. Thank you.
New York Times reporters Kate Conger and Ryan Mack. The book Character Limit: How Elon Musk Destroyed Twitter. Really good stuff. Thank you guys so much. All right, we're going to wrap up with the best MBA programs. I'm sure there's a few MBA programs out there that talk about Elon in their class. No doubt about that. This is Bloomberg Business Week.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
All right, everybody, getting ready to wrap up on the Wednesday edition of Bloomberg Business Week. Carol Masser, Tim is off. David Gora in the house with us. And we want to get to what one thing Bloomberg Business Week is so well known for. It's closely followed and often cited ranking of business schools.
Yes, it's out
Did you
now.
go to business school?
I did not go to business school.
Okay.
I don't know that we could talk about that. Is it worth me going to business school? We'll decide this afternoon. Dimitri Kasanides is with us here in the studio, and maybe we should start with just like the methodology. Sure. This is your world. You're immersed in it. There are other rankings of business schools. I'm breaking no news there by saying that. How is this ranking, this methodology different? And sort of what are you looking at?
It's a very complicated methodology.
Don't give away any trade
distill
secrets.
it down
Yes.
to the few key points. Several of the other rankings also do this, but we survey students, alums, and employers. We combine that with data that the schools also report to us. So we are taking in a lot of data. We're not going out there and seeking it out. And we combine all that data with a variety of formulas that fall under 5 indexes that we've developed.
And what gets the greatest weight?
Compensation, for
Okay.
example, is one that gets a lot of weight and more than others because Compensation, people misunderstand us when we say this. They think we're saying it's the only thing that motivates B-school students. No, it is not the only thing. But when you talk about the fact that you want to grow your career, you want to go into leadership,
yes,
even if you're making a switch, even if you're looking in nonprofit or social.
Bringing together enough talent in one organization is really hard to do. And if you're working on a problem that, may be modestly successful, it's kind of easy to get the first few people to join. You can give them a lot of equity. But then it gets really hard. Why is employee 20 going to join? Why does this matter to the world? Why should someone work on your startup versus any of the other things they could do? And picking something that matters if you're successful is a great way to do that. And so I think it's really important to think about when you're starting the company, how is this going to evolve into a vision that a lot of people want to help with, that a lot of people want to be associated with? Because I think getting talent and getting mind share is really hard in the current environment, and people are interested in startups that matter. Another thing that we've noticed among our best founders again and again and again is that they have a confident and definite view of the future. They may be wrong, and so we say it's good to be confident and flexible, but this idea that you are confident and definite, this is what I think is going to happen, or this is what is going to happen. And being relatively sure of that, having courage of your convictions, being a clear leader, saying we're going to do this, and that's why, even in the face of a lot of doubt, that seems to really correlate with success. And this comes back to having an ambitious vision, but the entire startup ecosystem is best set up to support companies that have a low chance of success, but are huge if they work. And I think going for something that is huge if it works will attract the best people. I'm not going to talk too much about the team. There are a lot of obvious things I could say that have been said many times by many people about, you need smart people who want to work really hard and who communicate well. These are all really true. But I'd like to mention a few non-obvious things that we've noticed that we don't hear people say as much about the team you need to assemble. Vinod Khosla says that the team you build is the company you build, and I really think that's true. I've still met only a handful of founders, I think, that spend enough time on recruiting, like Mark Zuckerberg is famously one of them. But building a great team, I think other than picking the right market and building a great product is the most important thing you do. All founders go through a transition, all successful founders, where you switch from building a product to building a company, and building a company really is about the team. So you need optimists. The whole world will be telling you why you're going to fail as a startup. If you don't have that internal fire of belief, if you don't have people who say, you know what, we are going to do this, and it doesn't matter what the haters say, we're going to figure this out, and there is, this problem, it must be solvable. If you don't have the spirit of optimism on the team, it's very hard to succeed when the world continues to punch you in the face. You need at least some idea generators. There are a handful of people in any company that has gone on to be really successful that I've been able to work with who are just really good at coming up with lots of ideas. You don't want too many of these people because that's more ideas than a company can follow through on. But having some people within a company that are just constantly throwing out new ideas, most of which will be bad, turns out to be super important to have on the team.
Applications being down over the last 10 years. We did a big story and analysis of that just about a year ago. Those numbers are slightly up now. International became a very big focus at many schools in terms of recruiting and how they're going to keep up the level of selectivity while not having to expand how many people they're accepting that don't quite have the qualifications they want. But I don't think there's been a huge dramatic difference in recent years, and I think some of what we're seeing is, again, ways of addressing what the students want that maybe is appealing to people and making up for that.
We're short of time, so we can't get into this ROI calculator, but it's very cool. It's on the site. Everyone should check that out. And then also, we didn't get into, you look at international schools as well. So this is not just a U.S.-focused thing. And 30 seconds left. I mean, that's challenging, but you do yeoman's work.
Yes, well, it's a lot of work, but really hats off to the data analysts on the team here that are doing the hard work in this. And then we're out there talking to people. International Indeed, this year, IMD, you had David Bach in here. I don't know if you recall that. He is the newly sort of installed leader of that institution based in Lausanne, Switzerland. Look him up, look up the interview that Carol and Tim did, look at what they're doing.
And you did